All right, chapter 14, conventional. This is financing one, and then the next chapter 15 will be financing two. This is the second chapter of the loans on mortgages. So, chapter 14, financing one, conventional FHA and VA loans. In this chapter, we're going to talk about issues concerning mortgage financing, including various payment plans. We're going to distinguish differences among conventional, insured, guaranteed loans, and New Jersey's home buyers programs as well. Now, home purchasers often require a down payment and a loan because most people don't have all the cash that's required in order to buy real estate. So they got to borrow some money. Interest is the charge, the rents paid to use or borrow someone else's money, and it's calculated on an annual basis. Value means 100%. Anytime we're trying to determine value, we're trying to determine all of it. So value, therefore, is equal to 100%. LTV stands for loan to value ratio. You'll need to know this just for your working and everyday business of real estate. People will come up with mortgage pre-approval letters or pre-qualification letters, and there'll be listed LTVs on there. You're going to have mortgage reps coming to your office talking to you about the different loan programs, and they'll tell you, yeah, the LTV on this loan program is that. We got this program, it's got an LTV of that. What does that mean? Loan to value. Well, it's describing how much the lender will loan you in relation to the appraised value of the property, not any ridiculous offer that somebody's willing to make on it. So here's an example. You get your typical conventional loans require 20% down. So the lender will loan you 80%. So the LTV is 80%. So 100% minus the 80%, the borrower got to put down 20%. That's how you'd calculate it. Now, we know FHA loans require 3.5% down payment. So what's the LTV on FHA loan? 100% minus 3.5 is 96.5. So the lender will loan you 96.5% of the value of the property with an FHA loan. Therefore, they need to put down 3.5%. That's how you could read an LTV. That's all it means, okay? It's just describing how much the lender will loan you in relation to the value of the property, and therefore you could figure out how much the borrower needs to put down. And we know that equity is the difference between the current value of the property and the amount that's owed on it. So equity can be built in different ways. I told you 3 ways it can be built. You could pay down the debt, building up equity. You could use inflation as a hedge as market values fluctuate, market values go up. You build equity. And then home improvements, forcing the buildup of equity by doing improvements on the property, increasing the value of it. You could build equity that way as well. So what is equity? Well, I just explained it. So let's just highlight now. At the time of the purchase, the buyer's equity is equal to their down payment. Usually. So equity is the difference between the value of a property and what is owed on it. Anybody know what determines market value? What is market value? It's the price that a ready, willing, and able buyer is willing to pay. Right? They got to be willing to pay, able to pay. Whatever that going rate is, that people are making offers to purchase it for. That average would be the market value, right? What's somebody willing to pay for a property? What they're ready, willing, and able to pay is what establishes market value. Market values fluctuates on the availability of money when you have to borrow money. Interest rates have an effect on it, right? There's a lot of factors. The economy could have factor on that, where maybe somebody doesn't want to spend their money, they want to hold on to it because maybe times are getting a little rough. So what is going to happen in those instances when interest rates go up and the economy gets tough? What happens to the property values? They fall, right? Most people can borrow less. If you got higher interest rates, they could borrow less money. You're pre-qualified, but they got to take into consideration the interest rate. What is interest? It's the rent that you pay for the using of somebody else's money. So you got to factor in the money that I'm borrowing from you plus the rent I have to pay on it. What can I afford in total? It's kind of like your car payments, right? How much could I afford in total? Well, the interest rate is going to have an effect on that. So, all right, you guys got that, right? So interest is the rent the borrower pays the lender for the use of the lender's money. On page 268, you can highlight that. And the amount of mortgage loan in relation to the value of the home is the LTV, the loan to value ratio, how much they'll lend you in relation to the value, the appraised value, not just some ridiculous eBay frenzy, ridiculous price that somebody offered. When you got multiple offer situations and stuff, people kind of get a little crazy sometimes, and they may offer more. They get caught up in it. Lenders are not going to loan you more than what the market value is. Now, who are they going to rely on to tell them that? Because lenders can be on the other side of the country. So whose word are they going to rely on it's worth? You got to get an appraisal done. Okay? Who pays for the appraisal? If you're getting a loan, who pays for the appraisal? Sorry, somebody was saying something. I didn't get it all.
I think bank can pay for that.
No, the bank selects the appraiser from a list of licensed appraisers, but the borrower pays for the appraisal. It's your loan, you got to pay for the appraisal. So interest rates charged by lending, check this out. So the LTV ratio has increased from 40% in 1920s. 1920. So what does that mean? If the LTV is 40%, how much did the borrower have to put down? They needed 60% of the cash to put down. Well, you got to remember in the 20s, that was the Great Depression too, to as much as 95 or 100% or more today. Payment periods have also lengthened from 5 years in 1920s to as much as 30 or more today. Times was in the 20s, huh? You needed to have 60% of the cash to put down when buying a house, and you could only borrow 40% of the money, and they'd only give you 5 years to pay it back. So interest rates charged by lending institutions on home mortgages, they vary as changes occur in the money market. As interest rates move up, an established fixed rate mortgage with a low interest could be a plus when selling a home if the existing mortgage is assumable and it can be taken over by the next buyer. On the other hand, if the mortgage interest rates fall, homeowners may seek to pay off their loan and refinance at a lower interest rate. To buffer the effects of unstable money markets, Lenders have been offering many alternative forms of mortgages in recent years, such as adjustable rate mortgages. We call them ARMs for short, their abbreviation. Seller financing gains popularity in times of tight mortgage money when the banks aren't lending. And for years, potential homeowners have been able to receive assistance in obtaining low down payment mortgage loans through government programs like the FHA, the Federal Housing Administration. They insure loans. And the Department of Veterans Affairs, the VA, they guarantee loans. So in addition, private mortgage insurance companies offer programs that enable loan applicants to receive higher LTV ratios from private lenders than they would otherwise. We're going to learn about what a PMI, private mortgage insurance, is and all these other loan programs. We're going to be going over them in this chapter. So we learned that interest rates, they fluctuate in the market on a regular basis. And when interest rates are high, alternative forms of financing become more attractive, like those ARMs and seller financing. We have government programs that also make purchasing properties more affordable. That may allow for a higher LTV ratio through the programs from the FHA and the VA, or from New Jersey's own state program called the NJHMFA. That's the New Jersey Housing Mortgage and Finance Agency. Or the REC-D, which is a part of the USDA, United States Department of Agriculture. They used to be called the Farmers Home Loan Association. They'd give loans to farmers and people who live in rural areas who you don't necessarily need to be a farmer for. They also give loans to people on Indian reservations as well. Through the REC-D today, you could still get 100% financing in rural areas. Anyone know what a rural area is? Well, a rural area is like living in the country where people live far away from each other. You may not even be able to see your neighbor, The homes are spread out. It's like the farmland out in the country. Suburban area, an urban area, let's go from the middle. Urban area is a densely populated area where you got people living within a tight proximity. You got high rises and apartment buildings, right? They live close together. It's a densely populated area. Suburban area or suburbia, that's like one family and two family homes. That's suburbia. You live out in the suburbs now, away from the city, right? And then you got rural, which is out in the country. It's important to understand these terms since you're going to be involved in real estate. What is urban? What is suburban? What is rural? All right. Let's go over some fixed rate loan program types. We're going to go over some terms here. Amortize. The word amortize means to kill off slowly over time. And that's exactly what the amortized loans do. You kill off the loan agonizingly slow over time through your periodic mortgage payments that pay down the amount you borrowed, which is called the principal, and the interest, the rent that you pay for the borrowing of that money. So because the word amortize means to kill off, a fully amortized loan means that by the time you make your last mortgage payment, you fully killed off that baby, right? You fully killed it off. So that last mortgage payment totally kills off the loan. Now, when you make those mortgage payments, your payment first gets applied towards the interest and then the balance towards the principal. So you got to pay the rent first before they start crediting you towards your paying down the debt. So the payment amount doesn't change in a fixed rate, fully amortized loan. The payment amount does not change. It remains constant over the entire life of the loan. Your first mortgage payment to your last, it remains the same. The payment gets applied first to the interest owed and the balance towards the principal, the amount borrowed, the term, whatever it is. 10-year loan, 15, 20, 25, 30-year, 40-year loan. Most common loan is 30 years, 360 months. By the time you make that last payment, you fully amortized the loan. You fully killed it. You killed it off. So your balance should be zero. A straight loan is an interest-only loan. These are meant for short loan periods, for people who are fixing up houses and flipping them, or if they have to purchase the next home before they sell their current one. Most people can't afford to make two different mortgage payments, so they could get what's called a bridge loan, which is a type of straight loan. It's an interest-only loan. It's meant for short periods of time, giving you long enough so that you could swing the payment on both properties in the interim until you're able to actually close on the sale of your existing property. Okay. Now, we usually try to coincide when people are selling one house and buying another. We try to coincide their closings within 30 days of each other so that they don't have to make mortgage payments on two properties. But that's not always possible. And when that's not possible, that buyer needs to get a bridge loan so that they can bridge the gap of time so that they could swing the payment in the interim. It's also known as a swing loan and interim loan. Okay. Now, it's short term. It's used by people who fix and flip houses, those builders. So let's highlight these things, what amortized means and where your payments get applied to. I believe there's an exam question on that. Your mortgage payment gets applied first to what, and then the balance to what? You need to know. Your mortgage payments get first applied towards the interest owed, and then the balance towards the principal. These loans are also referred to as self-liquidating loans. Now, there's a lot of different mortgage plans out there, but most of them, you got to make a mortgage payment once a month.
Can you repeat what mortgage loans get applied to?
Yeah, it's right here. The second sentence here, regular payments are applied first to the interest owed and the balance applied to the principal amount over the term, whatever the term is.
Thank you.
You're welcome. Everybody good?
Yes.
Okay. Now, amortized means to kill off. Fully amortized means you fully killed it. So what does partially amortized mean? It means you only partially killed it. So by the time you make the last mortgage payment, there's still going to be a balance. You're going to need to put another bullet in that baby to kill it. Right? That bullet being a larger mortgage payment. So that final mortgage payment that you make on that loan is going to have to be larger in order to fully amortize it, to fully kill it. So a partially amortized loan partially kills off the loan. Periodic payments do not fully amortize it by the end of the term. Why not? Because your mortgage payments during the term of the loan can be lower. So therefore, that last payment you make is larger than the rest. It balloons in size. So that's why they call it a balloon payment. Now, the benefit to getting these partially amortized loans that have a balloon payment at the end is that your monthly mortgage payment would be lower during the entire term of the life of the loan. Just realize that the last loan payment is going to be larger than the rest. Now, there's a way to avoid this. Once you get a lot of equity built into the property, just refinance, and your mortgage payments will be lower as well. Now, biweekly mortgages, a lot of people misinterpret these. They think you have to make 2 mortgage payments a month, biweekly. No, you're making a half mortgage payment every 2 weeks, the equivalent of 26 half payments a year, which is equal to 13 monthly payments. Wait a minute. How many months are there in a year?
12.
So 13 months would mean that there's 1 extra payment. That 1 extra payment would get applied entirely towards your principal. What is the principal? It's the amount you borrow. Not the rent, it entirely gets applied towards the principal. So if you make 1 extra monthly payment a year and apply it towards the principal, you could actually reduce the time on a 30-year fixed rate mortgage by 7 or 8 years. Can you imagine that? Doing away, saving 7 to 8 years of mortgage payments by making 1 extra payment a year if you apply it entirely towards the principal. That's a huge savings. You know what that it comes out to? I'll show you on a next slide. On a 30-year mortgage with only a 5% interest rate on a $300,000 loan, this could save you over $50,000 in payments. Now, you don't need to set up your loan as a biweekly mortgage. Some lenders may charge you a fee to set it up. It's not like it's that much effort that they got to put in there. It's an Excel file that instantly creates the plan for them. But you could just set this up by, hey, you got some extra change in your pocket, throw it in the bin till you save up enough to make an extra mortgage payment. Just make sure when you make that extra mortgage payment, you tell the lender that it's to be applied entirely towards the principal. Because if you do not, you know what they're going to apply it to? The interest. And then next month they'll be like, you're good now. You don't need to make a payment this month. You're good. No, I saved up that money to pay down the principal. So you could charge me less interest. I'm not trying to pay interest in advance. I'm trying to pay down my debt so that you could charge me less interest. All right, so here, let's do some highlights. Fully amortized loans, the most frequently used plan. An interest-only loan is a straight loan. A final payment that's larger than the others is called the balloon payment, and that is with a partially amortized loan. And biweekly mortgages involve half payments every 2 weeks instead of monthly. So that's the equivalent of 13 monthly payments a year, with that extra payment getting applied entirely to the principal. Let me know when you have those highlights in.
I got it.
I just need a second.
Sure.
Okay, I got it.
Sorry about that. Talking to my client there. Here's that example I have prepared for you in comparing two different loans. We'll go over this at a later time in detail so I could show you how to figure this out, because on exam, state exam, they'll usually ask you how much can you save on interest on a 25-year loan versus a 30-year loan. And for that, you need to know how to figure it out. I'll go over in detail how to calculate it. But just take a look right now. I just want you to look and see the difference here. By paying it off 5 years sooner, you're saving $53,460. Now, this is for two different loan types altogether, though. If you've got just a 30-year loan and you make one extra mortgage payment per year, it'll save you even more money than that. So, which would save you more money? Let's see if you guys have been paying attention. If you get a loan at a lower interest rate, or you get the property at a lower price, which saves you more money? Getting the loan at a lower interest rate or the property at a lower price? All right, so here I have a couple of, this is from a financial channel. They're talking about this very issue. I just need to jack up the volume on it because I'm pretty sure it's pretty quiet. So let me try to jack it up a little bit. And there's some papers rustling in the background during this recording. Sorry, I was recording it on TV. And then I put it here on the slideshow.
Yeah, hey Seth, I want to ask you something about the housing market. My wife and I are looking to buy a new home. I've read that the housing market is in a recession, and that maybe, and I've been told by various people, hey, no, hold off, don't buy right now, that prices may be inflated. Is the housing market in a recession? Is now not a good time to buy, or is it? Or is it? I don't know.
You know, it's a broader question, John, and a lot of it depends on where in the country you are. What we tell people all the time is what you want to make sure you're not doing is overbuying house. If you're looking at your interest rate right now, and to Dan's point, that inflation is what's causing interest rates to go up because the Fed's trying to get that under control. So you've got this compounding issue in the housing market. The problem you got, I would say the one thing you want to focus on is you can refinance interest rates. You can't refinance principal. Principal, whatever you pay for that house is what you bought that house at. Now, in certain pockets, maybe where you are in Miami, where I am in Texas, not where Dan is up in New Jersey, I think in our neck of the woods, prices are going to stabilize. They may not go up as fast, but I think they'll still continue to go up. Maybe not even drop. If you're in a cash position, that's great. If you're up where Dan is, I think they're going to drop. So you might have a buying opportunity. But where we are, I think you might want to, if you find the right deal, get it. But plan to refinance as soon as interest rates do drop.
Yeah, Dan, I don't know where you are, but I read recently that Jersey City has now become the most expensive city in America. I used to live in Jersey City, and boy, I wish I would have bought when I lived there way back 15 years ago, whenever it was. Seth Benson and Dan Geltrude, I appreciate you guys coming on for Money Huddle.
Now, since this report, which was well over a year ago, prices still have not fallen here in New Jersey. The prices are actually even still rising, and the interest rates they managed to stabilize and even drop a little bit, but they're creeping up. They're You're creeping up a little bit. So they dropped a little bit, but then they're creeping up a little bit. So they're still pretty low. They're at 5% interest rate right now. Is high fours, low fives is where we're at right now on interest rates. But property values still seem to be going up.
Appreciate it. Have a good day.
Like I told you, my the listing I got there in Island for a 1-bedroom, 1-bathroom condo is $265,000. I think that's inflated, but hell, people are still willing to pay it, And what determines market value? Whenever a price, a ready, willing, and able buyer is ready to pay, willing to pay, and able to pay. So how do your payments get applied? Hold on a second, let me lower my volume here. Got it all jacked up for that video. Okay. Your monthly mortgage payment on a 30-year fixed rate loan. I told you your payments first get applied towards interest and then the balance towards the principal. Now, each one of these lines here signifies a year of mortgage payments. Okay, the dark part of the line, the dark color, that's how much of your monthly mortgage payment gets applied towards the interest, and the light color, all the way here at the tippy top, that's how much goes towards paying back what you borrowed, the principal. How come for at least the first half of a 30-year loan, the majority of your mortgage payment goes towards the interest? How come they don't just split it 50-50 all the way through? Anybody know? Why would you guess that they don't just set it up that way? I mean, they could still make the same amount of money. The bank can still make the same amount of money if by setting it for the 30-year mortgage that you're going to pay them the same amount, so they could still make the same amount of money. But how come they do this? Why do they charge all that interest up front like that and only apply a small amount of your mortgage payment towards paying down the debt, the principal, for the first half of the loan, and then it starts to switch? Why do they do that?
They gotta pay commission to the mortgage lender.
No, it has nothing to do with commission.
I guess that's how it works in life insurance policies.
You got an idea why they do that in mortgages here?
Because the principal amount is fixed.
Yeah, this is a 30-year fixed rate loan. How come out of your monthly mortgage payment for the first half of the loan, the majority of your monthly mortgage payment goes towards the interest and a small amount towards the principal for the first half of the loan? And then after that, it starts switching, and more of your monthly mortgage payment goes towards the principal. Why do they do it this way instead of applying it 50-50 all the way through?
I guess they want to book the profit because they're gonna resell it later.
No, I'm talking about the lender. Why is the lender charging you this? How come they're applying your monthly mortgage payments this way?
Is there any possibility that if the amount, like principal amount, will like become less, then the interest rate also become less? No?
Isn't it so you could just pay off your interest first? Or
Why? That's what it seems like, but why?
borrowing interest, so you would have to.
You're asking something.
You can refinance the interest, not the principal.
How long do people stay in homes before they move? Are they staying in homes for full 30 years these days?
No.
No. So the bank loads up their interest up front so that they can collect as much of their profit, their rent. because they know that most people are not going to stay in a property for 30 years these days. We've become more of a nomadic society. You know, you don't need to live by the factory where you're going to work and live and retire from, right? It's people don't work like that anymore. You got people that are going to college and everybody wants to be the boss. And now they get these jobs where they can work remotely, or they could, they don't need to be by the factory where they're building the widgets. You know, we don't build anything here in America anymore. So people move around a lot more. Plus, unstable households, you know, divorces are a lot more common, you know, single parent families, you know, all these changes in society, they play a role in how often people move. So, because of these reasons, people do not stay in the homes that long. So the lenders want to get more of their money up front because they know that the likelihood is that if you move, they're not gonna earn as much on that same loan. So they stack it up front. That's the reason. All right, now let's start looking at another type of loan program called the adjustable rate mortgage. The adjustable rate mortgage, or for short, shifts the risk or reward of these changing interest rates that are always fluctuating from the lender to the borrower. Because if the lender offers a fixed rate loan to the consumer, to the borrower, and interest rates rise, we're stuck there having their money locked in your investment in your house at a much lower interest rate when they could be earning a lot more. In an adjustable rate mortgage, if they start you out at a low interest rate, but then interest rates go up, well, they shift the risk or reward to the consumer rather than taking it on themselves. So if the interest rates go up, the borrower pays more. If the interest rates go down, the borrower pays less. People are always like, you got to stay away from those things. You never know what the interest rate's going to be. Those rates, they can always be going up and down, you know. Well, they do. However, your interest rate on your loan will only get adjusted once a year, usually on the anniversary of the loan. That's the adjustment period. Now, people are like, yeah, but when they do adjust, those rates can skyrocket on you. Well, what determines if the rates go up or down? They usually tie it to some sort of an index. And that index is most commonly the 1-year US Treasury bill. Depending on if the interest rates go up or down on them will determine whether they go up and down on your loan. Margin is the difference. You know, it costs the lender money to lend you money. Okay, so how much it costs the lender to get the money to lend to you is the margin. So if they want to make, if it costs them 2% to get the money to lend to you, and they want to make 2%, how much do they need to charge you? 4%. That's the markup. That's the margin. Now, people are always like, oh my God, those interest rates, they could shoot up on you, though, during that one adjustment period. No, they can't. There's a cap. A cap is the maximum that the interest can go up in any single adjustment period. And the ceiling is like a lifetime cap on the entire loan. It's the maximum the interest rate can go up over the entire life of the loan. Here, think of it this way. Let me get you a visual out of the garbage can here next to me. I got a bottle over here. I'm gonna show you a little visual. Let me see. Get me a full screen here. Oh. All right, so I got a bottle here of something. Let's just say that this was a bottle of something carbonated in soda, and I shook it up. what's preventing that? What's the highest that soda can shoot up in the air? What is preventing it from going any higher than this level?
Cap.
The cap, kind of like the loan. What's the maximum that the interest rate can go up in any single adjustment period? The cap. Now, if you were to take off the cap now, what's the highest that it can go now? I'm indoors. What's above me?
The ceiling.
There you go. So there's a way to try to remember what the cap and what the ceiling are. Think of the visual of the cap on the bottle of soda. The cap is the highest that it could go up in any single adjustment period. If you take the cap off, it could go even higher, but that's the most that it could go over the entire life of the loan. It'll hit the ceiling. It can't go up any higher than that. Okay. And we got a worse case scenario when borrowers, some people say, oh, you don't want to get those adjustable rate loans. Those payments can skyrocket on you. You never know what they're going to be. That's false. At the time you sign the paperwork to get the loan, one of those papers, which you need to sign right next to this, they show you the worst case scenario for your loan under the highest interest rate that's possible over the entire life of your loan, what your monthly mortgage payment would be like. So they have that page with that worst case scenario, and the font is like that big. It's like 1/3 of the size of the page almost. It's like a huge font. And you need to sign right next to that. So those borrowers that are saying, oh, you never know. Well, they either never looked at the paperwork that they were signing. I mean, it was pretty big font, or they're just being disingenuous, So this is the anatomy of an ARM, an adjustable rate mortgage. That's how they work. Now, do people ever get the wrong loans for their applications? Yeah, there's a lot of different loan programs out there, and different loan programs are used for different purposes. Do people ever use the wrong loan program for their purpose? Yeah, and then they blame everybody else for it when it doesn't work out the way that they planned. Especially if it's in a time where lenders are threatened to give loans to people who would not normally qualify for them. Otherwise, they would get fined or even lose their license, because they say if you don't give loans to these people that don't normally qualify for loans, which would be minorities or low-income people, this is the way that it was phrased by a certain congressman. He said, well, then you're engaging in racist activities for your banking, and we're going to fine you heavily if we don't just take away your license. Now, this actually did happen back in 2001. At the time, there was a senator that was in charge of the Banking Oversight Committee. His name was Barney Frank. Today, he tries to, act like he was the hero that saved everybody. But it was really interesting. If you ever look at any of those, not CNN, C-SPAN. Those C-SPAN records those boring congressional hearings all the time. I seen it on the news where they took the C-SPAN hearing where he was threatening the lenders that if you don't start writing more loans to poor people and minorities, we're going to give you sanctions. We're going to fine you heavily and maybe even remove your ability to do banking in the United States. will yank your license. So the banks, they were listening to these hearings. They listened to these congressional leaders who have the power to do that. And they're like, you say what? Say what? Okay, well, let me ask you a question. How do you make people who are low income and don't make enough money to qualify to get loans? How do you make them more affordable for them? Or how do you make them qualify for loans that they normally would not qualify for? Shouldn't require too much thought. You lower the lending standards. Right? You lower your standards. And they were forced to do that basically by this congressman that threatened them. He was the head of the Banking Oversight Committee. So the banks were like, okay, you sure? Okay, we'll do that. But you know that a lot of these borrowers will eventually default. I mean, we could tell you the ratings in the book before we even start doing this. A lot of them are going to end up defaulting. He was like, hear that? If you don't start getting loans to poor people and minorities, then you're violating the law. You're not treating people equally, and you're engaging in racist activities. Okay, and they're like, yeah, sure, all right. Even though the banking enforcers and the oversight under Barney Frank said that, well, that's not how banks write loans. Banks write loans dependent on your debt and your income and your credit score, and they factor in risk. So what your debt to income ratio is. They look at your tax returns, your pay stubs, your bank statements. They look at your credit score, which is your likelihood and history of paying these debts back on time, right? So banks like, okay, sure, we'll lower the lending standards. So how do they do that? How do they lower lending standards? Well,
Lower credit score and income.
okay, they could require a lower credit score. They could require lower income, but that's not really a safe way to practice banking. So they have to try to do it another way. And this is what they introduced back then. They called it SISA, stated income, stated assets. The borrower does not need to produce evidence of their bank statements or pay stubs or tax returns. They just need to tell the lender how much money they make and how much assets they have and what their approximate debts are, and none of it is verified. They did that. And when they did that, all kinds of people started coming out of the woodwork getting loans. But do people start lying in their loan applications now too, so that they could borrow more, so they could afford a more expensive property too? Sure do. And maybe they'll buy multifamily houses and have them as investments, right? Oh, I couldn't afford to buy that multifamily house. That's all right. Lie about your income. Lie about your assets. Now you qualify for it. Don't worry about it. The mortgage is going to get supported and paid by your renters anyway, right? As long as they continue to pay the rent. What could possibly go wrong? So that's around the time where you saw property values starting to shoot up. Oh, by the way, you guys could do these highlights while I explain this still. That's around the time where you saw property values starting to shoot up until they reached the peak, which was in 2006. And that's when the mortgage market bubble bursts. Now, if you talk to a lot of people, they say, no, the mortgage market didn't burst, the bubble didn't burst until 2008, 2008-ish and 9-ish. No, that's not true. It burst in 2006, but it was a slow week because the value started dropping. And in 2007 or 8, that's when it really ramped up and started coming down at a steeper level. But the real estate market started to crash in 2006. So I got a little thing written up here. A lot of people blame the real estate mortgage market crash of 2006 on adjustable rate mortgages. However, there was a lot more to it than that. Anybody watch that movie called The Big Short? Anybody ever see that movie, The Big Short? It's a star pack loaded with celebrities. Yeah, Brad Pitt, Brian Gosling, tons of comedians and actors that are really famous that were in that movie. But they do a decent job explaining what actually happened in the mortgage industry when the mortgage market crashed. It's called The Big Short. Now, it doesn't completely cover the part that I just explained about Barney Frank and the oversight committee and all that, because that would pull politics in, and Hollywood does not want to step on their main supporters that are always in line with them politically. So they didn't bring politics into it and explain that part. But the politics is a very important part because that's what started the whole explosion of the people being able to get loans that they normally couldn't afford. Now, if people now can get loans that they previously could not afford because they lowered the lending standard, what does that do for people who could already afford to get the loans?
They'll have to pay higher rates.
No, it's like you already could qualify for a loan to buy a house. But now they lower the lending standards so that people who previously couldn't qualify to get a loan can now get a loan. You already could qualify to get a loan, and now they lowered the lending standards. What does that mean to you?
Well, I guess it's more competitive. The prices will go up.
That
Not
means
affordable.
you could buy more. And if you could buy more, it's going to improve prices. One word, more. It's natural. If people can afford to pay more, the owners are going to pay more. And people, that's why this artificial real estate bubble happened and occurred. It caused the market to fluctuate like that so rapidly. If you were to look at the real estate markets fluctuating in 2001, then goes to 2006, it was like, boom, like the market just skyrocketed. Watch the movie The Big Short. Write that down when you guys get a chance. Try to watch that movie called The Big Short. It does a great job explaining it. They show you how a bus driver was writing down on his loan application to get a house that he makes $300,000 a year. You know, I mean, they had a scene. One guy was talking to this lady. She works as a stripper, and she bought like 10 homes. Yeah, she's like, I'm making mad money now. I'm able to buy all these homes because my mortgage rep, yeah, he's hooked me up with all of these mortgages that are what they're called hybrid mortgages. It's a combination adjustable rate mortgage with a fixed rate mortgage. It's fixed for the first couple years at a teaser rate, and then it adjusts, you know? So the guy's like in the movie, and he's like, oh yeah, okay. She's like, yeah, this is great. I can afford to make the payments on these. I can afford to now have all of these houses now, and I'm making mad money on it. Bah, bah, bah. And then the guy asked her, he's like, well, what are you going to do when the interest rates go up and the payments go up? And she's like, say what? She's like, "Didn't tell me that." Well, that's when people start losing houses, especially if you can't refinance them now. Anybody know what the word refinance means? What is a refinance? Refinancing is when you already have a loan You get a new loan to pay off the old loan, and hopefully at a lower interest rate. However, can you get a new loan to pay off an old loan if the collateral of the house is not worth as much anymore because the prices went down? You may have trouble refinancing. And that's exactly what happened when the mortgage market, the bubble burst and property values started dropping. People who tried to refinance those adjustable rate mortgages couldn't refinance them because who's going to give you a loan to pay off your existing loan, a new loan to pay off your existing loan that's worth, that the loan is more than what the house is worth? No lender is going to do that. And that's why there's a lot of people having trouble doing that and ended up losing their homes to foreclosure. Or maybe we tried doing short sales left and right for people to avoid the foreclosure. All right, so there we go. So here's the anatomy of the adjustable rate mortgage. You can write next to this. Cap is the maximum the interest rate can go up in any single adjustment period. Ceiling is sometimes called the lifetime cap. It's the maximum allowable interest over the life of the loan. Okay.
I got it.
All right, everybody good? So we learned that amortize means to kill off slowly over time. You have a fully amortized loan. You have partially amortized loans, which then have balloon payments, which the last payment balloons in size. That's why they call it a balloon payment. And then we have a situation called negative amortization. So if amortize means to kill off, and negative is the opposite. So negative amortization is when your monthly mortgage payment isn't even enough to cover the interest owed. So therefore, that shortfall in payment of the rent is to next month's balance of your principal that you failed to pay. So now you start paying interest on your unpaid interest. That's not a good situation. Right? So that's negative amortization. So some lenders have loan programs with teaser rates that are below current market interest rates. The lender sets up these loans this way, knowing that it's negatively amortizing, but they're going to eat the loss because they know they'll make up for it in the long run. However, there are some loan programs that are out there where the lender allows the borrower to choose what payment they make each month. I remember Countrywide Home Loans was the largest lender in the world for mortgage lending. They're now defunct. I believe Bank of America bought them up. They wrote a lot of failed loans, but they had very innovative commercials. They were the first one that I know of that had those cartoon drawings with the sketches with the pencils that then get animated. You know, you see them all the time on TV now, right? Well, they had a very innovative commercial there where they said, when you get a loan with Countrywide Home Loans, we realize that sometimes little things that we didn't anticipate pop up in life. And so they're drawing this kid on a bicycle, and then he starts pedaling the bicycle. And they said, we realize sometimes unexpected expenses pop up. And then they drew a rock in front of him. He hit the rock, flew head over heels, and broke his leg or arm or whatever. And then an ambulance drove up and it took him away. So they were like, with Countrywide Home Loans, you stay out of that trap with our pick a fee payment mortgage loan program. So you could either make your regular monthly mortgage payment that'll go towards your principal and interest, or sometimes you have a little more money and you could pay more towards your principal. Or maybe these unexpected expenses come up and then you could pay interest only or less than interest only. And giving people those options, which option are they probably going to choose? The cheapest payment possible, which is negative amortization then. It's a negative amortization situation. And they do it until the lender finally calls them and says, hey, you can't, you took enough, like every payment you've been making was less than interest only. We're starting to feel sorry for you because you're getting yourself in a really bad situation. So you can't do that anymore. You got to start paying towards the loan, paying it down now. Because a lot of people were doing that and getting themselves in bad situations. Okay. So, let's see, best for short-term ownership or when a buyer plans to refinance later to a fixed rate loan. However, that could be risky if property values fall. It's basically gambling, and that's what a lot of people did. They went out and got these adjustable rate loans that gave these low teaser rates that you could get into these loans. And then if the interest rates went up, so does your payment. And then that could be a problem for people. And then they are going to want to refinance into a fixed rate loan, but they're going to have trouble doing that if the property values drop. It's gambling to think that you can do that. Oh, property values always go up. When I get enough equity, I'll just refinance into a fixed rate loan. That's the thinking of a lot of people. And they weren't anticipating that market bubble bursting and then not being able to refinance. And now they're getting foreclosed on because they can't afford to make the mortgage payments. So negative amortization, let's highlight, is when the monthly mortgage payment isn't even enough to cover the interest due. That's page 270. Everybody get it? Find it? Bottom of the page, last paragraph.
I got it.
All right, now we got those hybrid mortgages, which is a mix, I told you already, of a fixed rate loan, a teaser rate that's fixed for the first year, 3 or 5 or even 7 years. And then afterwards, it becomes adjustable. That's what's referred to as a hybrid mortgage loan. Yeah, that can get people in trouble too, because it's fixed. They tease you to get into it because they'll offer you that low teaser rate for the first year. Then the next year it goes up, but it still stays at a fixed rate now for the next couple of years. But now you're at least like at the lowest of the interest rate that's available there in the market. And then in a couple of years, it becomes adjustable to whatever the going rate is. So a straight loan is a short-term interest-only loan. They're also used by builders, flippers, and for bridge loans when buying your next home before you close on the sale of your existing one. So just next to interest-only loans on page 271, right next to the title, straight loan for short term, used by builders, flippers, and as bridge loans. So what do they call an interest-only loan? A straight loan. right? Interest. I suppose we could get into this after lunch. It's got to be about lunchtime now. Yes, it is. So let me pause the recording. All right, so interest is the charge, the rent for using someone else's money when you borrow, and it's calculated on an annual basis. We'll go over the math of that in a little while, but an amortization schedule is a chart that shows the balance and how many payments are being and how the payments are being applied towards the principal and towards the interest over the term of the loan. So you could basically look at, in a 30-year mortgage, there's 360 payments. So you could look at any particular month over the entire lifespan of the entire loan and see what the balance should be, how much of the payment goes towards the principal, how much goes towards the interest at any given time during the life of that loan. That's what an amortization schedule does. A point is prepaid interest on the loan, and a point is calculated based on each point is 1% of the loan amount, not the purchase price. They could be referred to as discount points sometimes in the language. Payment of points could allow for borrowing more money or qualifying for the loan if your debt to income ratio is a little bit out of whack. Or you could do it as you could prepay points to get a buy down, a lower interest rate. You could purchase a lower interest rate by prepaying interest on the loan. Probably never makes sense to do that. You're better off if you have extra money, instead of paying extra interest up front to get a lower interest rate. You're better off using that money to pay down the principal. That's less money that the lender can charge you interest on because you're borrowing less. So a point is prepaid interest on the loan. It is tax deductible by the borrower because it's their loan. They're the one that gets the statement at the end of the year. So it's tax deductible by the borrower in the year it's paid. It could be paid by the points, can be paid by the buyer, the seller, or the seller. But who gets to deduct them on their taxes? The borrower, the buyer, because it's their loan. They get the statement at the end of the year, the interest statement. So it's tax deductible by the borrower in the year it's paid, even if the seller paid for it. Now, a rate lock is no longer mentioned in this book. I guess they did it by mistake. They mistakenly removed it. Well, actually, they do mention rate lock. Sorry about that. Page 271. 271, they do. A rate lock is a guarantee by the lender to issue the loan at a quoted interest rate as an incentive to the borrower. Under some conditions, the rate can still change. Okay, they don't tell you a whole lot about it. All right, so I will. Here's I even got a screenshot on a different slide, but here we go. A rate lock. Yeah, they removed it back in the 15th version book and forgot, and have left it out ever since. Oh no, they removed, that's where it was last in. They removed it from the 16th version. But you still need to know it. The lender locks in the rate so that even if the rate rises, the borrower gets the lower locked in interest rate. They could extend it and purchase a 30, 45, or 60-day rate lock if they need additional time. After the complimentary rate lock period expires that the lender usually gives. We'll have a screenshot for that on the coming slides here, though. So interest is a charge for the use of someone else's money. That's the rent that you pay for borrowing someone else's money. We've already gone over that, and I think you already had that highlighted, I believe. I believe, 272. Nope, maybe not. 272, top of the page. Under interest. Okay, a rate lock. Here's a slide I put together because it is not in this book. The little one-liner that they gave in the book doesn't really tell you much. A rate lock is a guarantee by the lender to issue the loan at the quoted interest rate as an incentive to the borrower. That doesn't tell you a whole lot about it. So here, a rate lock is when the lender offers a complimentary rate lock. So lock in the rate so that if the rates go up, the borrower gets the lower locked in interest rate. So that interest rates will be held lower for them. Now, this can be for 30, 45, or 60-day rate lock. And if missed, the borrower could purchase an extension for an additional cost. So here's a screenshot from the older version book that talked about rate locks. The lender may offer the borrowers an opportunity to lock in at a quoted rate. In this situation, the lender agrees to hold the quoted rate for a certain period of time. If the interest rate goes up, the borrower is protected. Unfortunately, if interest rate goes down, the borrower often can't take advantage. Well, sure they can. They could say that they're going to go to a different lender if they don't lower the rate to whatever the current rate is. And then they'll end up lowering the rate for them. Borrowers typically can lock in a rate for 30, 45, or 60 days and hope they get to closing before the rate lock expires. This is why a lot of people complain about real estate agents. They say that we're always pushing them through the transaction, and it seems like the agent just wanted to get their commission. I tell you guys, how do you be a better agent? You educate your clients. So explain to them what you're doing. Don't just push them through. Oh, you need to get this done. You need to get that done. Okay, we got to order this. We got to do that. It seems like you're being pushy and you just want to get your commission really quick. Explain to your clients, I'm doing this to help you so that you don't miss the rate lock. Your lender quoted you a certain interest rate, and if the interest rates go up, you're going to have to pay a higher interest rate. They've got you locked in for a certain period of time, and I'm trying to get you to the closing table before your rate lock expires. Because if it does, you could still keep the lower interest rate, but you're going to have to pay hundreds of dollars in order to keep it. So I'm trying to help save you money. See? If you explain that to your clients, then they're going to be like, yeah, my agent was great. They were helping us save money. They kept nudging me along the whole time, but they were trying to do it so that they could save me money. But if the agent doesn't explain it to them, they think that you're just pushing them along because you just want to get to the closing so you get your commission and get paid. Okay. Educate your clients. This is not in the book. There's nowhere to highlight this. Snap a picture of this. Okay. It's not in the book. Complimentary lock. Let's see what slide. There we go. Because when a lender offers a complimentary lock on the rate, so if they go up, the borrower gets the lower locked-in interest rate. This could be for 30, 45, 60 days. And if missed, the borrower could purchase an extension for an additional cost. So a rate lock is when the lender offers complimentary lock on the rate. So if they go up, the borrower gets the lower locked-in interest rate. This could be for 30, 45, 60 days. Okay. Boom, 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 boom. Ay, ay, ay. The rate lock. All right, there we go. So, interest is the charge, the rent for using or borrowing someone else's money. And interest is calculated on an annual basis, like I said. You take the loan amount times the interest rate, that'll give you the annual interest rate. You divide that by 12 to tell you what this month's interest rate is. And then you subtract that from the total mortgage balance. And that gives you the total principal and interest. All right. So PI, let me see. So to figure out the principal, what the principal balance is, you take the loan amount times the interest rate equals the annual interest divided by 12. That equals the monthly interest. Subtract it from the total mortgage payment, which is the principal and interest, or PI, and then that'll give you the principal, the amount left, the current balance. So here's an example of that. You can see on page 272. The loan amount is $100,000. The interest rate 7%. 100,000 times 7%. That's $1,000 divided by 12, and it tells you that first month's mortgage payment, whatever it is, $583.33 of it is going towards paying the interest, the rent of borrowing that money. Now, if your monthly mortgage payment is $665.31, the lender would have given you that. That's your PI, the principal and interest is what composes your mortgage payment. You subtract that interest that we just calculated from the principal and interest, and you're left with the principal. So PI minus I equals P, right? I just showed you how to calculate it. It's simple math, but you're allowed to use a calculator. All right, and then that $81.97 of that mortgage payment went to pay down your principal for that month. Now, subtract that $81.97 from your original loan amount, and that gives you your new remaining balance. Want to figure out what it's going to be for the next month? Start over at step 1. But take $99,918.03 times 7%, divide it by 12, subtract that from your monthly mortgage payment. And if you keep doing that once for every month over the life of a loan, now you just created an amortization schedule. That's how you do it. That's how lenders do it. Okay. So PITI stands for principal, interest, taxes, and insurance. That's your total monthly expense for housing. And if it's included in your mortgage payment, they refer to that as a budget loan. Because you can better handle your budget because you know your total expenses for housing are included in your mortgage payment. PITI. What does PITI stand for? You need to know. Principal, interest, taxes, and insurance. How do you calculate your interest? How much of your monthly mortgage payment goes towards the principal? Well, get your mortgage payment. That's principal and interest. Now take the loan amount, the total loan amount, times it by the interest rate, divide it by 12. Now subtract that amount from your total monthly mortgage payment to get that principal. You guys may want to write this here, calculating interest and amortization annually, and put a highlighted box around this on page 272. You're going to need that formula. You're also going to need to know. Here's the formula. PI minus I equals P. But here's the real formula, how to really figure it out. Loan amount times the interest rate divided by 12. That gives you the monthly interest for that first month. And subtract it from your monthly mortgage payment of PI to get the P. All right, here is the first 3 months and the last 3 months in the amortization chart that you could see on the bottom of page 272. By the way, number 2 over here, this is wrong. Change the 3 to an 8. That's a 3 written there. It should be an 8. It's a typo. But one thing you see here, you know that this is a 30-year loan. Why? Because it's got 360 monthly payments. How many months are there in 30 years? Well, 30 times 12 is 360. So that's 360 months. All right. You know it's fully amortized fixed rate because the first payment all the way to the last is the same. The only thing that changes is how much gets applied towards the interest versus the principal over the life of the loan. And you know it's fully amortized because when you made the last payment, which did not change, what was the ending balance? It was fully amortized, fully killed off. Right? Here's how you could figure out what your mortgage payment's going to be. This is known as a mortgage factor chart. So at the top of page 273 above the chart, write mortgage factor chart like this. I give you some instructions here how to use this chart. There are instructions in the book of the chart. That paragraph above it explains how to use it as well. Basically, this is what you do. You locate your interest rate in the column here. You locate the number of years, the term of the loan that you're going to get. You run your finger down to one of the figures, like if it's a 6% 30-year loan. Run your finger down to 6%, here's 6, and then across to the 30-year column, and it's 6. Wow, that was even. What is that 6.00? For every $1,000 you borrow, your mortgage payment, including principal and interest, will be $6. That's what that is. That's your factor. They call that the mortgage factor. So 5% loan at 30 years, what's the mortgage factor? Let's see if you guys know how to read the chart.
5.37.
5.37. That's right. You put your finger on the rate, go down to 5%, and go all the way to the 30-year column, and it's 5.37. So, here, let me pull out my calculator on my cell phone here, and let me ask you guys a question. If you have a 30-year mortgage loan at a 5% interest rate, and the loan is for $400,000, what's your mortgage payment going to be? You got a 5% interest rate for 30 years, $400,000 loan amount. What's your monthly mortgage payment going to be? Use a calculator. What?
2,148.
Correct. And how did you get to that? Well, the factor is 5.37. You ran your finger down the rate column to 5 and then across to the 30-year. 5.37 is the factor. And the loan amount's $400,000. So for every $1,000 borrowed, your monthly mortgage payment is $5.37. So how many thousands are there in 400,000? 400. So 400 times 5.37 is 2148. Not too difficult, is it? Just got to know how to use the chart. All right. Here, let me blow your mind a little bit. How much of that 2148 goes to your first month's, how much of that 2148 gets applied towards your principal? For that, you need to have the factor chart. You need to have this chart right here to figure it out. All right. So what do? What's the first step? $400,000 times the interest rate, which was 5%. Divide that by 12, and what do you get? The loan amount, 400,000 times 5% divided by 12. What do you get?
Do we have to be exact? Like, would we do 5.37% or just 5%?
Well, 5.37 is not a percent. That's a dollar amount.
Okay.
Every $1,000 you borrow, your loan amount is $5.37. So we figured out that the mortgage payment is $2,148. So write that down and put it on the side somewhere. $2,148. What the hell's my pen? There we go. So $2,148. And what is that? Write PI next to that. That's your monthly mortgage payment of principal, which consists of principal and interest. So write down on a scrap piece of paper $2,148 and write PI next to that number so that you know what it is, so you don't get lost in your math. So the loan amount was how much? 400,000. So 400,000 times the interest rate of 5% gives you $20,000. That's annual interest. We then need to divide that by 12 months. And the monthly interest payment is $1,666.66, right? 1,666. We'll just leave it at that. And what is that? That is your interest, your I. So write I next to that so that you know what that is. That's your interest. Subtract the I from the PI and you get the P, the principal, right? So then 2148 minus 1666. And how much of your monthly mortgage payment, that $2,148, went to pay down the amount you borrowed, the principal? How much?
I'm a little confused. Wouldn't $100,000 times 5% be 5,000, or did I do it wrong?
It's not 100,000. What's the loan amount?
It wasn't 100,000?
It was 400,000,
Oh, okay.
right? So the question was, on a $400,000 loan at a 5% interest rate, what is your monthly mortgage payment? We use this chart, the mortgage factor chart, to figure that out by putting our finger down here, and then we get that 5.37. And that gave us that $2,148. That's your monthly mortgage payment, which consists of your principal and interest. Then I asked you, well, how much of that mortgage payment goes towards paying down the principal, the amount you borrow? Well, we have the interest rate and we have the loan amount, so we could figure out what the interest is and how is interest calculated on an annual basis. So if we took 400,000 times it by the interest rate of 5%, we got what, $20,000? That's annual though. We need to find out what that monthly interest payment was. So divide it by 12. And that gave us that 1666, right? So that's your monthly interest. Subtract the interest from the principal and interest, and you'll be left with the principal. So how much was the principal amount that you got? How much of that monthly mortgage payment went towards the principal?
481?
82.
You got an Apple, right? An iPhone? Yeah. $482. If you got an iPhone, 481. Just the way that they round it. Apples, for some reason, they round down. Okay. Yeah, so 482. 482. Okay. Doesn't matter. You can't use a cell phone, so don't worry about Apple or Android, because you can't use your cell phone's calculator on the exam. You have to use just a regular plain calculator like this. Okay. There's no formulas. It's not a real estate calculator. No cell phones, so you can't snap pictures of anything, you know. So that's the okay. So this is the formula on how to do it. You're going to need to know this for exams. You need to know, everybody know how to read this chart? They're going to give you this chart for your state exam. School exam, not yet. Coming soon, but not yet. So everybody know how to read this chart?
All from reference page.
See what I mean about people not answering me? Does everybody know how to read this chart?
Yes, I got it.
Yes.
What about the rest of y'all? This is important to know. You guys will get questions on exam. You need to know how to read this chart. It's not difficult. I just want to make sure you're following along. If you got a question, ask me. That's what I'm here for right now. Don't blame me you failed exams later because you didn't get the information if you didn't ask questions here during class. All right.
Yeah, all good. How was it?
Thank you. Well, don't worry, we're gonna give you more math problems on here. We're gonna practice more. Here is the showing you how politics once again plays a role in real estate. whether you like it or not, you got to be aware of what's going on in the world and not be so biased if you're Republican or if you're Democrat or if you're independent. If you hate Trump's guts, doesn't matter. You need to know what the laws are, what the rules are, and not listen to any twisted fake news, okay? Because right now, the big beautiful bill he's trying to get passed will renew these tax deductions, these tax breaks that President Trump has given to everybody, not just rich people. If you believe that, you're ignorant. These tax breaks are given to everybody here, and more so to middle class and poorer people. Look, well, actually, poor people really don't even pay much in tax, if any at all. It's the middle class, and then because if you're under a certain income, you don't really pay taxes on stuff. But look at this, the Tax Cuts and Jobs Act. Okay, here, let me read this. Trump attempted to end tax loopholes for the rich, at least somewhat. However, this negatively impacts states that have very high property taxes. New Jersey's one of them. We have the highest property taxes. Actually, many of the blue states do. For those with expensive homes and high property taxes, this is going to negatively affect you. All right. Now, you don't blame the president for that because the president doesn't set your property tax rates. Who does? Why are your property taxes so expensive?
Politicians, they come up with
What politicians? Is it the president? Does the president set or have anything to do with your real estate property taxes? How much you pay? No, they do not. They don't have anything to do with it. So who does? Who affects your property taxes the most? Because all level of government in your state does, somewhat. They have a percentage that plays a role. But mostly, what plays the biggest role in your property taxes? What politicians do? Is it the governor? Is it your mayor? Is it your city council members? They all play a role. But who plays a role the most? Well, it's your city council and your mayor. The council members, you voted for your friend because you knew them, because you went to school with them, so you voted to them for that position because you know them. I hope you know if they do a good job or not, too, and you follow up on that. You don't just vote for them because, hey, I know that guy. They were pretty cool. Well, what do they do? That's what matters. Now, I know people get outraged and they're always like, oh, the frickin' president, my frickin' taxes through the roof because the frickin' president. President has nothing to do with it. Real estate taxes are local. Where do the majority of your tax dollars go? The category of education, the schools, right? But where else does it go? Well, the little pet projects that your city council members want to do in town. But they can't just pass it on their own. They also got to run it by the mayor. And your mayor will sign off on it. Okay? So your city council and mayor both play the biggest role in your property taxes that you pay. If you don't like that your property taxes just went up, look at who your city council members are and who your mayor is, and vote them the hell out. Otherwise, you don't have the right to bitch and complain. Serious, I know people don't like politics, but probably people like protest about it, but yet they don't have a friggin' clue what the hell is going on in their lives. Okay, this is the way to do it. It's local. Real estate is local. Your taxes are local. Now, what did President Trump have to do with this? Well, he attempted to end tax loopholes for the rich by allowing you to make deductions on your federal taxes. Okay, so the Tax Cut and Jobs Act, the TCJA, which is in effect from 2018 to 2025. Wait, what year are we in right now? 2025. This is those supposedly tax breaks that Trump gave to rich people. Oh, really? Then how come he's telling everybody right now that if you don't pass his bill right now, which gave all kinds of tax breaks to you, the average person, your taxes are going to go up by 35%. Let's put it to a test. Keep hating Trump. Don't have your politicians root for your politicians to vote against his big, beautiful bill, right? And see what's going to happen. Your life is going to get a lot more expensive. So this allows homeowners to deduct interest on qualified home loans up to $750,000, down from $1 million in 2017. So he lowered it. For now, people have been bitching and complaining about this now that are in that 700 homes in 750 to $1 million range. Okay. Do you have a lot of money? Are you rich if you could afford a $750,000 or $1 million home? You got it pretty good. I don't know. How do you guys roll? I don't know what kind of money you guys are making. You have it pretty good if you're owning if you're able to own a house in the $750,000 to $1 million price range. I'd say you do. I'd say you're pretty good set. You know,
Yeah, on the global level, you probably like 1% for sure.
this is definitely somebody who's doing well if you could afford a house in this price range. So you should be able to afford the taxes. Unless your politicians in your state and your town raise those taxes over and over again over the years. And now you could complain about it all you want. But for some reason, people don't realize that this is done at the local level. So for taxpayers who use married filing, see, the president, he could only give you breaks on the interest that you pay on your loan for your mortgage loan. He's giving you tax breaks on that. You could write off the interest. It's tax deductible. Now, he figures, you know what? People are complaining. I give tax breaks to the rich. How about this? I'm only going to give tax breaks to people who own homes up to $750,000. It was $1 million. I'm lowering that to $750,000. Okay. So now you got people complaining, oh, he's raising our taxes because you got to pay interest now. We can't deduct the interest. See, this is all smoke and mirrors by your local politicians because they know that if you get a tax break somewhere else, they could raise your taxes somewhere, and it really doesn't change how much you spend on your housing overall, right? And they hope that you don't notice because it's still the same amount coming out of your pocket, except more of it is going locally to them. Until they raise the taxes again. So for taxpayers who use married filing separate status, the home acquisition debt limit is $375,000 for single filers. Oh my gosh. And the new law ended the deduction for interest on home equity lines of credit until 2026. So what does that mean? For those people who are using their house as a piggy bank to drain the equity out, to refinance, take the equity out so that they could go on vacation or buy a new car or something like that. He said you can't deduct that on your taxes no more. You can only deduct that interest if you're taking it out and reinvesting it in the real estate that you own, instead of using your house like a piggy bank. And then if property values drop, you decide you want to abandon it because my house ain't worth that. I'm not going to pay that. My house isn't worth it anymore. Just like it happened when the mortgage markets melted down. He's trying to prevent that from happening again. So unless one condition is met, the home equity line of credit or home equity loans are used to pay for improvements to the home. Boom, there you go. So the upper limit to state and local tax deduction, called the SALT deduction, is now available for property taxes up to $10,000 a year. Is $10,000 a lot to pay in property taxes? Well, for most people in the entire United States, it's extremely expensive. Unless you've got a very expensive home or you're in one of them extremely high tax states. And even for New Jersey, the average property taxes are $9,500 a year now in New Jersey. So most people, the average, they could still qualify for this. However, those who are paying more than $10,000 a year in property taxes, they're going to be pretty angry. Because Trump put limitations on the deductions. No, he's doing away with the loopholes for rich people to not pay their taxes. Okay, so everybody was complaining that he gives separate special tax breaks to rich people. You don't know what you're talking about. That's your local politicians that are taking advantage of you. This limit has been particularly hard on property owners in New Jersey, New York, and California. Very blue states, because the states have high property taxes. So the different income tax regulations apply to mortgage loans on investment properties, like than your homes that are your primary residence. Licensees should always recommend that clients consult with the tax person about their current tax regulations. So we don't need to study SALT tax deductions or the Tax Cuts and Jobs Act for exams or anything like that. You're not going to get this stuff on exams because it always changes and they don't update the exam that often. Okay. So, but this is just some interesting stuff so that you're aware of where these discounts or tax breaks are coming from. And if you're not getting them, why not? Maybe your property taxes are too high to begin with, so you don't qualify for the tax deductions. Well, who do you blame for that? Well, who made your taxes so high? And why are they so high? Right? That's the questions. You're asking the wrong questions. That's the questions you should be asking. All right, so let's get to the points of the math. Let's get to the point. Let's do some math here. A point is prepaid interest on your loan. It is tax deductible by the borrower in the year that they pay it. So when you first buy a house, the more points you pay up front, you could deduct on your taxes. It doesn't matter. You can negotiate for the seller to pay some interest on your loan. And if you could manage to pull that off, you get to write it off on your taxes as the buyer. So each point is equal to 1% of the loan amount, not the purchase price. That's very important to understand if you want to get a math problem right on your exam, school exam, state exam. We've both got questions about this. You'll have a math problem about it, and I'm going to give you an example to try to figure out, to see if you could figure it out. Now, I want nobody being quiet in class about this and not answering me and just staring at the screen. Pull out your calculator. I know you got a cell phone within arm's reach. It's got a calculator on it. You could use it, all right? So let's just do these highlights here. Prepaid interest. Each point is 1% of the new loan. So prepaid interest is called a point. Each point is 1% of the new loan. The IRS allows buyers to deduct them. What happened? Sorry about that. Wrong thing was highlighted there. It looks like some stuff was moved around. There you go. That's here. Everybody got that? Okay. So what's a buy down? It gives you the opportunity to purchase a lower interest rate. When you go to get a mortgage loan to buy real estate, what determines the interest rate that you're charged by the lender? It's the risk that you pose. It's called risk-based lending. Now, how do lenders calculate the risk to loan you money? How much risk you pose to them? If you're the higher the risk, the higher the interest rate they're going to charge you, or the more money they're going to require you to put down. So, what determines your level of risk? What goes into that? It's not on this screen, I'll tell you that.
Well, your ability to pay out the debt, like your income
And what shows your ability to pay off the debt?
or debt to income ratio.
Your debt to income ratio, how much money you're making in relation to how much you're spending already, your debt. What else? What shows me your history of paying your loans on time?
Oh, that's credit score.
Credit.
Your credit score, your FICO credit score. So your income, your debt to income ratio, your credit score, how much money you're putting down. How about how much backup funds you have in your bank account? What are your assets? Right? What if my car broke down and I need to do some repairs? I'm not going to make the mortgage payment because I need to get to work, so I got to fix my car, right? So your assets that you have in the bank, the more assets you got, the lower the risk you are. You know, all these things factor in. How much money am I putting down when I buy the house? You know, all of these things are factors that play a role. Okay, so we're going to get into that in a little bit more in just the coming slides. But let's talk about the buy down for a second. It never makes sense to do this. Don't ever do this. If you've got extra money, instead of purchasing a lower interest rate, you're better off just paying down the principal by that much. Okay, put that extra money towards paying down the principal. You could make a payment on your mortgage loan and make an overpayment and say, I want that overpayment to go towards my principal, so I owe less money next month. So when you're calculating the interest on my next month's payment, my principal balance is lower, so my payment's going to be low. Now, the borrower is better off using the money to pay down the purchase price. So that's what I say there, okay? They've got all kinds of programs with this, but it never makes sense. Economists will tell you that it makes no sense to purchase a lower interest rate. You're probably not going to be in that property long enough to benefit from the lower interest rate anyway on what you paid to get the lower interest rate.
But does it make sense to do it if you not just refinancing, but you also taking some cash out and using it like to buy another property or something?
Does it make more sense to do a buy down?
No, yeah, yeah. So does it make sense to do it if you're not just refinancing, but you?
So buy down is when forget about refinancing. We're initially getting a loan to buy the house. Only get a lower interest rate.
See.
Well, we calculate the interest rate based on your risk. But if you want, you could prepay some interest to buy down to buy a lower interest rate. Now you can also do that when you're refinancing too. But look, I found this. I've done this before myself, and I actually got tempted by it, and I bought a lower interest rate. And guess what? Shortly after, the interest rates dropped anymore, so dropped more significantly. So I refinanced again after I just did a refinance and I purchased the lower interest rate. So the money that I used to purchase that lower interest rate, I flushed it down the toilet. That's it. It was a waste because interest rates dropped and I refinanced to what they were, which was even lower than what I tried to purchase. So the savings never materialized. I just flushed that money down the toilet.
But those closing costs, are they tax deductible, the one that you incurred?
Well, we're not talking about the
During the refinance, aren't you you gotta pay some closing fees when you do that?
no, depending on the lender, who you're getting it from, you could get refinancing with no closing costs. You could get refinancing with no appraisal. It depends on the lender that you go to and how you negotiate with them too. Some they'll negotiate, some they won't, but it depends on your lender and their policy, basically. Look at the different lenders. Some of them advertise, hey, no closing costs when you refinance with
Yeah,
us.
there's always banks that do that. They're easy to work with.
And why do they do that?
Well, they want to get the numbers up.
It's your loan with no closing cost.
Well, they have cash flow.
Anything, What's in it for them? Why would they do that?
Well, they have a guaranteed annuity when, because they're getting somebody to be the client. So they'll keep collecting income.
Okay, pardon my French in advance, because they make a shitload of money.
Well, you can put it that way.
Let me back it up a little bit here or a lot. Where the hell was that? There we go. Remember this? I showed you this graph before. Look at this. On a 30-year loan at a 5% interest rate, when you're borrowing $300,000, if you were to keep that loan for the entire 30 years, by the time you pay off that loan, you would have paid back $579,960. In other words, to borrow $300,000, you paid $279,960 in interest. Is that juice worth the squeeze? Yeah, we'll waive the closing cost on that. It's worth it for them. They're making a load of money, right? It's right there. They're making a boatload of money. Or did we leave off here? Okay, so like I said, look at this. Now I got this slide here. It's pretty good. It is called risk-based lending. The best interest rate you could get is tied to the amount of risk to the lender. Factors include down payment amount, your FICO credit score, the debt to income ratio, known as the DTI, which we're going to learn about. I'm going to give you a definition for that, and you'll need to know it for exam. The value and condition of the property, as well as the local market conditions. Are they flat? Are they prices rising? Or is the market going down? What's the current state of the market? Because remember, real estate markets are cyclical. So even appraisers on their appraisal report, they have to state on there, is the market steady? Is it increasing or is it declining? And by what percentage? The appraisers need to do all kinds of crazy math to figure that stuff out. Now, PITI, pity the fool who gets that mortgage. So PITI stands for principal interest. That's your loan. That's the complete expense for your loan, right? Principal and interest. But your complete expense for your housing expense includes taxes and insurance, unless you're also getting a condo. And then you got a monthly HOA fee, which needs to be factored into that. So if your HOA fee is high, can that affect how much money you could borrow? Yes, it does. It's got to get factored in because it's a regular payment that's continuing. So, PITI is your complete monthly expense for housing. Principal, interest, property taxes, and homeowners insurance. That's what it stands for. And if you have a condo, you got to factor in the HOA fee. PITI loan is also known as a budget loan because you could budget your expenses better if you got everything built into one payment, right? You know what the one payment's going to be all the time instead of having to do multiple payments on stuff. Do you need to include your property taxes and homeowners insurance in your mortgage bill? No. But if you do, your lender will give you an 1/8 of a point discount on your interest rate. Why are they trying to incentivize you? Because they want to make sure these very important bills are being paid. You don't pay your taxes, it could jeopardize their collateral. You don't pay your homeowner's insurance and keep it insured, you're jeopardizing their collateral. So the juice is worth the squeeze for them to offer you an 1/8 of a point discount on your interest rate that they're charging you to include that in your monthly mortgage payment. But you don't have to. Reserves, we learned this about once before when it comes to condo associations and co-ops, but there's reserve for loans too. What are reserves? It's an amount of money built up for the coming year's future expenses. The first time you're charged when you first get a loan, you have to build up that reserve account for the coming year's property taxes and homeowners insurance expenses. Now, RESPA law, that's the Real Estate Settlement Procedures Act. RESPA law limits the amount of reserves that a lender is allowed to charge by law. Lenders have to do periodic accounting annually throughout the year, and they have to return excess money in the reserve accounts that they over collected if it's $50 or more above the tolerance amount that they're allowed to collect. So, what does RESPA stand for? Real Estate Settlement Procedures. What are reserves? An amount of money built up for the coming year's futures expenses. What is PITI? It's your principal, interest, property taxes, and homeowners insurance. What's a PITI loan also known as? A budget loan. All right. So let's highlight that now in the book. PITI, what does that stand for? A PITI loan known as a budget loan. And what is RESPA? It's the Real Estate Settlement Procedures Act. And it does a lot of stuff. RESPA is a huge law that includes a lot of timelines, a lot of disclosures and things that the lender has to do. RESPA law covers a lot of stuff. It also includes that the lender has to give to the borrower the final expenses before the closing occurs. They have to disclose to them at least 3 days before the closing what all the final closing expenses are. You know, there's a lot of disclosures required under RESPA law. If you want to question one of the lender's charges, you could send them a letter on a form and under TILA, the Truth in Lending Act, and the lender is required to respond to it within 30 days. And if they don't, they could be held liable for fines and penalties and expenses to pay you. They have to acknowledge that they've received your letter within 30 days, and then they have like another 45 or 60 days to respond with the information you requested. All right, I'll show you a little video on that one, where a guy ends up foreclosing on a bank, another one, because the lender tried overcharging them on their homeowners insurance. Okay, so everybody got these highlights? Page 274?
Yes.
Okey-dokey. About with this guy. I know he looks like Count Dracula, doesn't he? He looks kind of like Dracula. I think he wants to be a vampire. He even kind of like filed down his incisors if you take a look at it when he talks. Uh, so yeah, people are peculiar, but either way, he's a smart dude. He seems to got his stuff together. If you listen to how he speaks and what he's talking about here. Now, this is a part of RESPA law. These are RESPA letters. It's
This morning from Philadelphia.
I got to turn up the volume so that you could hear this. And let me make sure that the sound is optimized on the computer here. All right, let me turn up my volume. And here, let's listen to this guy. This is interesting.
Hey, Patrick.
Hey, how are you?
I'm doing well. So explain this for us. You actually had a home that Wells Fargo came to you and said, look, you need to take out a homeowner's insurance policy that you don't think it's worth the value of your home. What did you do to Wells Fargo in response?
I told them I wasn't going to renew that policy that they were having me renew. I had an insurance policy on my house, which I had bought for $180,000. And Wells went to the insurance company and said that they wanted me to insure it for $1 million. And as you can imagine, the premium on a policy like that is through the roof. So I said, no, I'm not going to do it. And they said, well, we're going to do it for you. And they force-placed an insurance policy for me that doesn't cover me. It only covers them. And that was the genesis of a dispute with them that's been running for nearly 2 years now.
Well, we did reach out to Wells Fargo, got no response from them. It sounds just like your experience with them, no response at all. Are you surprised by that?
Welcome to the world of dealing with Wells Fargo. No, I'm not surprised at all.
You also then found an interesting loophole, or not a loophole, but you found an interesting law dating back to the 1970s, which enabled you to work this angle, which is they needed to respond to you within 20 days. They needed to respond to you with written responses to your inquiries. They didn't do so, and therefore you were able to place a levy on their office and foreclose on them?
That's true. There's a law called RESPA, and there's a 20-day window that they have to acknowledge receipt of your request, and then they have 60 days to actually respond to that request. And if they don't, it's possible for you to collect damages and even additional fines on top of the damages. So I took them to court here in Philadelphia through the municipal court system. I won a judgment. They ignored the judgment. The court advised them they had to pay. They ignored that court's advice. And so I got a sheriff's levy, and when they ignored that, I ordered a sheriff's sale on their branch in downtown Philadelphia. And they still weren't going to pay. But let me tell you, when the media coverage started and it was on the front page of the business section that their office furniture was going to be sold off to pay a judgment, I had a check in my hands the next day.
Brilliant. And I can imagine a lot of viewers this morning waking up wondering if they're in a similar position. Do you think that your story opens the floodgates for other people watching this morning?
I think it does. I mean, people ask me what I hope to get out of this, and one thing is if I wind up being the Johnny Appleseed of RESPA letters, I would absolutely love for that to be my epitaph. These RESPA letters are not difficult to write. There are numerous consumer resources sites on the internet. There's government sites on the internet that'll help you with that process. And these RESPA letters, the banks are legally required to respond to them. So I would say to consumers, these are a very important tool if you're having a problem communicating with your mortgage lender.
Patrick Rogers from my home city of Philadelphia, good luck to you, and thanks for coming in and telling your story this morning.
Thanks for having me on.
Thanks, Patrick. Coming up here on the show, the budget protests in Wisconsin.
Pretty interesting, huh? Now you know that if you could dispute with the lender, you could make a formal request for them to provide information. They have to respond, he said, within 20 days that they've received your letter, and then within 60 days have to respond with the information that you requested. Otherwise, they could be held liable to you with fines and penalties. That's RESPA law for you. It's like at the beginning of the loan, when you first apply for a loan. The lender is required, when you complete the loan application, they're required to supply the borrower with a package that shows them how to shop for and compare loans. We're going to go over a lot of these timelines and documents that they need to that the lender needs to give. Why? Because you need to know it for exam.
This morning.
No, oh, by the way,
But,
one,
yeah, but most of the banks probably have that information down pack, like or we just assume that.
well, it's not the local bank that keeps your mortgage papers. They send it up to headquarters somewhere, their division that deals with the lending. You can't go into every office and get a loan for the mortgage. You may need an appointment when the mortgage rep will be there so that they could come there. Or you may have to go to a different branch for that. You know, different banks operate a little bit differently, but usually every office doesn't have someone there 24/7 on staff ready to give you a loan and has the knowledge about that. They definitely don't keep the paperwork there. Hell, most banks don't even have vaults anymore. Right?
Right.
By the way, he made a reference there. Was anybody familiar with that? The Johnny Appleseed? You know, if I was the Johnny Appleseed of RESPA letters, remember he said that?
Yeah, he said it, but I didn't hear that story before.
Anybody remember what Johnny Appleseed is? Johnny Appleseed, this is another thing when our country was developing. Was a guy that was going around planting seeds for apple trees all over the place, right? Now, when our country was developing and we were starting to build roads, we did not have that much money to pay all the workers. So they planted all these seeds to make these apple trees, and then they would, a popular liquor back then was called Applejack. It was made out of apples. Very strong liquor, by the way. They would pay the workers that paved our roads in liquor. You wonder why our roadways are so screwed up here. Now you know they were drunk when they were making them. Oh, you can't make this stuff up. All right, so look, the point of the math. Let's see, once again. So a point is prepaid interest on a loan, tax deductible by the borrower in the year that they paid them. And the math of a point is that each point is equal to 1% of the loan amount, not the purchase price. So here's a question for you. Bust out them calculators. It's very similar to a question I know that you get on the school exam. The numbers are just different, but the question is very similar to one you get on school exam. And you'll probably get one on state too pertaining to this. If the purchase price is $325,000 and the buyer has to put 20% down and pay 2 points and $5,000 in closing costs, how much money does the buyer need to purchase this house? Let's first talk it out before you bust out with a calculator. What would be your first step here?
Figure out your portion of the down payment. What is it in dollars?
And why would you do that?
So it's 325 multiplied by 0.2. Kind of do it in one way. Just I multiply to the 0.2 decimal point, which is 20%.
Why would you do that first? You're right, but I want to make sure you know why you're right.
I mean, this is, we have to calculate how much money in total we're gonna get. So, and then the points will get calculated through it as well.
Well, it has something to do with the points. Your down payment, the points are based on what value? How do you calculate a point?
So it's a 1%, I think
That's
one unit.
Yeah. It's 1% of the loan amount, right? Not the purchase price.
Yes. So the difference of your down payment, that's how you get the points.
A lot of people will try to figure out points because, look, I got this on the screen in front of you. On the exam, you're not. You're just going to get that question. if you were just to try to calculate the points based on the purchase price, you're basically, what are the points? The prepaid interest. You'd be paying, if you don't deduct your down payment amount first, you're calculating the points to pay interest on your own money that you already put down. Do you want to pay interest on your own money to the lender? No. So you got to figure out what that down payment is and subtract it first so that you know what the loan amount is. And then you calculate the points based on the loan amount. Okay, that being said, I'm going to shut my mouth and I'm going to let you guys have a few minutes to try to figure out what the answer is.
Well, we gotta text you.
You could just hold on to it too. Just let me know when you got it. You could text it to me too. You could send it to me in the chat window. And then I will reveal it. See how many of you got it. I'll even do it because I forgot what it is offhand, but let me pull up my calculator. I'll look it up really quick.
I don't think we can send it to you only. Can we?
And you could pull me down and pull my name in the drop down so that you only send it to me.
I don't know. For some reason I don't have a drop down. Oh. Oh.
Oh, there you go. Okay, Michael, you got it. All right, Eddie, you got, oh, no. Did you type it right? You may want to look at that again, Ed. Oh, there you go. Now, wow, came scrambled, and then it disappeared, then it came back. Okay, yeah, you got it. So Ed and Mike, you guys got it. Jervin, you got it. Is anybody else working on it? James, you got it. All right, let me reveal it now. Here, I'll look it up step by step. Oh, hold on a second. Somebody else sent me. Yep, Caroline, you got it. All right, let's take a look at this. $325,000 times 20%. That's your down payment amount. Your down payment at 20% is $65,000. You subtract that $65,000 from the total purchase price to get the loan amount. The points are calculated based on the loan amount. Each point is 1%. So we got 2 points, that's 2%. 260 times 2% is $5,200. So far, we have $65,000, the 20% payment.
Oh, you guys don't have like an outlet And like my battery's dying, like I'm trying to find like an outlet to plug in for a minute.
We have the 2 points, the 5,200, and then we got the 5,000 in closing costs. We have them all. $75,200 is needed to buy this property. If anybody wants to snap a picture of that, how we figured that out, be my guest. Otherwise, the slideshow is available for you here to see it again. I'm going to do another one, this time using an FHA loan with the same property, so that I can show you how some of these government programs make it more affordable to get into housing. Before I do, let's just let me reword that same exact question that you had in the previous slide. Here was the question, and here's the same exact problem worded differently. See, there's 2 ways that it can be worded, but it's saying the same exact thing. If the purchase price is $325,000 with an LTV of 80%, and the buyer needs to pay 2 points and $5,000 in closing costs, how much does the buyer need to complete this purchase? See, it's the same thing as this, except they're not spelling it out for you how much the down payment is. You need to know what an LTV means and figure out that the down payment is 20%. If they're willing to lend you 80%, the down payment is 20%. So there's an extra step there. You need to know what an LTV is when it's reworded this way. Okay, now let me give you this problem again if it was an FHA loan. It's the same exact thing. You're purchasing the property for $325,000. You have a purchase, is the purchase price. 3.5% minimum down payment is required for the FHA type loan. You got to pay 2 points and $5,000 in closing costs. So how much money is needed to purchase this property using an FHA loan? Hey, we got answers starting to come in. I just want to get everybody's answer there first, and then I'm just going to reveal it on screen so I don't have to type in all the math myself. Feeling lazy. So I'll get everybody's answer here. And then I'll do the reveal on screen. Okay, I'm getting different numbers from different people, so let's see. Okay. All right, so let me start working it out for you on screen, see if you got it right. So $325,000 purchase price times the 3.5%. That means it's an $11,375 down payment. That's your 3.5%. Subtract that from the purchase price, and we get a loan amount of $313,625. Okay, still got answers coming in here. Keep them coming in. And the points are calculated off that loan amount. So 313,625, the loan amount, times the 2% is $6,272.50. So far we have the down payment of 3.5%, the $11,375, $11,375, plus the $6,272.50, plus the $5,000 in closing costs, is $22,647.50. Those that did not get that, did you see what you did wrong? Okey doke. Oh, I see you fixed it anyway. Okay, you got it anyway. All right. So it's not that difficult, especially when you got a calculator in front of you, right? You just got to know how to figure it out. You need to know the formulas. Okay. In this case, the secret is knowing how to calculate a point. You got to subtract your down payment to figure out the loan amount first. And remember, the rent, the interest that you pay is where the majority of the money gets applied to first in your monthly mortgage payment, and the balance gets applied towards the principal over the term. We got that mortgage factor chart, which is used to determine what your monthly mortgage payment is, based on the term and the interest rate you're able to get the loan for. Now, I asked you guys before, can an interest rate determine how much you could borrow? And I'll show you, yes, it can. Because what is, if we're going to buy a $400,000 house at a 5% interest rate, what is your mortgage payment going to be?
What do you say?
If you're going to buy a $400,000 house at a 5% interest rate, what is your mortgage payment going to be? $2,148. We did this problem before. Remember, you go down to the 5% and then across to the 30-year term. And it's based on how many thousands? So 400 times 5.37 is $2,148. Now, let's just say interest rates went up and it's now at 6% for 30 years. So that's 6.00. So 400 times 6.00, and that's 2,400. So 2,400 versus $2,148. That's 1% difference. If it goes up to 7%, 400 times the factor 665. Now your mortgage payment is $2,660. So the interest rate does play it does have a direct impact on how much you could borrow or how much you could afford. Look how the the monthly mortgage payment is going up. Now let's go back to the one that 5% interest rate. Oh, let me see. I may have one coming up. Let me see. Let me look at the slideshow. I got some coming up in the slideshow. I don't have to make up any. I got it coming up in the slideshow. I could just show you in the next slide. So in the meantime, taxes and affordability. Can your property taxes and affordability. This is an interesting thing I've seen about affordability to live in different states. Which states are the most affordable and which are the least? So
The report, by the way, noted.
And this is based on if you have a $1 million in your savings. If you have $1 million in your savings, how long would that last you in retirement? Well, let's see. Do your property taxes play a role in that? Yeah, sure. It's a cost of living, right?
That even with $1 million in retirement savings, the average person would only be able to cover about 14 years of expenses in New York City, and I'm not sure it would go that far. New Jersey came in 49th in affordability, followed by Vermont, Massachusetts, Maryland, Washington, Connecticut, Maine, Illinois, and Oregon. California not in there, making up the bottom 10. Okay, let's get to the other side of the story. Where's the most affordable place? Alabama, number one, as the most affordable state to retire in, followed by Tennessee, West Virginia, South Carolina, Wyoming, Delaware, Georgia, Arkansas, Florida, and Mississippi. In other words, the South. All right, Stu, there you go. New York, though, not very affordable, apparently.
that was a very nice summary. In other words, the South.
All right. So let's see now. I mean, let's open our eyes to a little bit of reality here now, too. So let's see. So how do we calculate the monthly payment? You take the amount borrowed per 1,000, times it by the factor using the factor chart, equals your monthly mortgage payment, the PI, the principal and interest. So how do you calculate the monthly interest? The loan amount, the full loan amount, not per 1,000, but the full loan amount, times the interest rate, divided by 12 will give you the monthly interest. So how do you calculate the monthly principal? You take your monthly mortgage payment, PI, subtract your monthly interest payment, the I, and that'll be left with the P, the principal. So on a $400,000 loan for 30 years at a 5%, what is the factor using the factor chart on that previous page? What was it? 5%? Factor was 5.37.
5.37.
Yeah. So there you go, 5.37. So how much is the monthly mortgage payment and how much of that goes towards paying down the principal? Well, I'll show it to you on screen. We'll do this part together for this one. Remember, it's 400,000, so it's per 1,000 borrowed. So 400 times the factor of 5.37. Remember, that's not a percentage, that's a dollar amount. Equals your mortgage payment of principal and interest of $2,148. Now, if you take the loan amount, times it by the interest rate, that gives you the annual interest, divide that by 12, that gives you your monthly interests. So you subtract the monthly interest from the principal and interest to get the principal. PI minus I, you shake it all about and you get your P, the principal of $482. Now let's take this a step further. If your property taxes were $9,000 a year and your property insurance was $900 a year, what is your monthly PITI payment? Remember, your PI is $2,148. So what is your total monthly expense for housing, the PITI? If your annual taxes are $9,000 a year and the insurance is $900 a year, how do you calculate this? You take your taxes, add it to your insurance, the annual, make sure they're both annual. You get your $9,900, but then you need to divide that by 12 to figure out what the monthly is. $825 in taxes and insurance monthly. So that's a significant increase. So taxes can play a major role, right, in how much in affordability. So you take your PI, add it to your TI, shake it all about, and you get your PITI. $2,973 is your mortgage payment, is your monthly housing payment now. Take your mortgage payment plus your property taxes and homeowners insurance. Now that could have just made that property out of reach for some. So taxes and insurance can play a major role in affordability. But that's how you calculate. That's how you calculate it. If you get any questions asking how to calculate PITI or how to calculate what your principal was, that's how. Anybody want to snap a picture before I change the slide on this? Okay.
Got it.
So how do you compare two mortgage loans? I showed you the chart on this before and what the savings was. You're welcome. Welcome. Yeah, I tried to work it out and show you the step-by-step on that. Okay, so here's a question similar to a question you get on state exam. They usually give you a question to compare two loans to figure out if you know how to figure it out. I showed you how to figure out what your monthly mortgage payment is, how to calculate how much of that goes towards your principal, because I also showed you how to calculate your interest, your monthly interest payment. Now, here, I still need to show you how to do something. I mean, I told you, but it was really quick in passing. I don't know if everybody caught it. But let's see. I'm going to ask you a question. I don't want you to do any math yet. I just want you to tell me, how would you approach solving this problem? It says, how much would you save on interest over the life of a loan on a 25-year loan versus a 30-year loan? If the loan amount was $300,000 and the interest rate is 5%, how much would you save on the loan if it was a 25-year loan versus a 30-year loan? What would you do to try to figure out the answer on this? What's the strategy? What do we do? I'll tell you what you got to do is you got to do a loan comparison side by side, first of all. So you're going to have to use those charts to calculate you got to find out what your factor is to figure out what the monthly mortgage payment's going to be, right? And you're going to have to compare them side by side. But even when you got that, it's not enough to figure out the answer to this problem. Because look, what is the factor on a 25-year loan at 5% interest? What's the factor on a 25-year loan at 5% interest rate?
5.85.
5.85 is correct. And what is the factor on a 30-year loan? It's 5.37. So you would use that to figure out what?
What the PI is?
And what is PI? Principal and interest. That's your monthly mortgage payment. Right? Okay, so how does that help you figure out how much you'd save in interest over the entire life of a loan? Ouch. Didn't think get that far yet. So now what? There's a little trick to this. It's not that difficult, but when I tell you, you're going to be like, duh, but let's see if you could get it. Did you guys figure it out? I'll give you a little tip. The first day of class, I had you highlight something on the inside cover of the book. It tells you the formula for how to calculate interest over the life of a loan. The tip here is you need to know when you get the monthly mortgage payment, which includes principal and interest, what are you going to do with that? You need to know how many months are there in a 25-year loan and multiply that monthly mortgage payment times that. And how many months are there in a 30-year loan? And multiply your monthly mortgage payment times that. And that'll tell you how much you paid in total over the life of the loan. And then you could just simply subtract the amount you borrowed. And that'll give you the interest that you paid in both. And then you subtract the interest on one loan from the other to give you the difference. So here we go. You're going to need this factor chart to figure it out. And here it is. Here's that question once again. And everything is broken down for you. How much would you save in interest payments on a 25-year loan versus a 30-year loan for a $300,000 loan at a 5% interest rate? Well, we learned that the factor by using the chart is 5.85 for a 25-year loan and a 5.37 for a 30-year loan. Now, how many payments are there in the life of a 25-year loan? Well, 25 years times 12 months a year is 300 months. In a 30-year loan, 30 years times 12 months is 360 months. So if the loan amount was $300,000, you figure out the monthly mortgage payment by per thousand borrowed. So there's 300s and 300,000. So 300 times the factor gives you the monthly PI. The monthly mortgage payment is $1,755 in a 25-year loan and $1,611 in a 30-year loan. Times it by the number of months in 30 years and 25 years respectively, and you could see what the total you would paid off in 25 years or 30 years. Now just subtract the amount you borrowed from that and you'll get the interest. Now you subtract the interest from both loans to figure out the difference, the savings. If you want to snap a picture of this, be my guest once again. But this is one that they often give on state exam. Not the school. You're not going to get this on the school exam, but state exam, possible. Probable. Okay.
I have a question.
Sure.
On the 30-year loan, why we are multiplying the interest dollar amount with 300 months? It should be 360.
Over here you're talking about?
Yeah.
Yeah, you know what? I should have used maybe a $400,000 loan amount here because that's mixing things up a little bit. This is the amount that you're borrowing. This is your loan amount per thousands. 300 times the factor is your monthly mortgage payment. That's not the number of months.
Okay. Okay.
This just gives you the monthly principal and interest. That's your
Okay.
mortgage payment of $1,611. The number down here is the number of months, 360. See, I took that monthly mortgage payment of $1,611 times 360. Okay. Yeah, and I know that's a little confusing because of the number there, the loan amount. Okay. Everybody good? Anybody else got questions? Okay. Anybody need to snap a picture? Snap a picture before I change it. All right. Okay, there's a couple more problems here. We're not going to go over them, but there's a couple more problems in this slideshow if you wanted to do a couple more samples. We also got this T formula I taught you. Small number goes up top, large number on one side, and an interest rate on the other. TGIF, the top number goes in the calculator first. And you divide down and multiply across to find the missing component. If you have 2 out of the 3 of these components, you could figure out the missing one. And it works on a lot of different problems. As you could see here, here's 5 different problems that you could solve with this. If you don't have this and you want to snap a picture of it, be my guest. All right, here's one problem. If the monthly interest payment is 5%, if the monthly interest payment at 5% is $1,250 a month, what is the principal amount of this loan? Now, I already filled in here $15,000. You may be wondering where that came from. Well, the monthly interest of $1,250, you got to remember, interest is calculated on an annual basis. So if they give you the monthly interest, you need to multiply it by 12 to get the annual interest, because they're asking you what is the loan amount. So because if it's related to the loan amount and not the monthly mortgage payment, that's different. They're asking what the loan amount is. We need to figure out what the annual interest is here. So $1,250 times 12, that's $15,000. That's why we wrote 15,000 up there. The problem I told you is that 5% interest rate. So how do we calculate this? TGIF, top number goes in the calculator first. 15,000 divided by 5%, which can be converted to 0.05. Remember, to convert interest to a whole number, you cross out the percentage and then go 2 decimal points to the left, which would be 0.05. And that gives you $300,000. All right. Here's that formula once again. All right, now, the Your Home Loan Toolkit, we're done with the math for now. Yay! Your Home Loan Toolkit. What the hell is that? Well, it's a step-by-step guide explaining how to shop for home loan costs and warns consumers about the pitfalls and the charges from lenders when shopping for a loan. Lenders are required by the CFPB to provide this toolkit within 3 business days of completed loan application. Aliens. All right, there's a little bit to unpack there. What is the CFPB? That's the Consumer Financial Protection Bureau. They never existed until President Obama created it during his tenure. This is a new agency that he created, and some people likened it to a 4th branch of government. Why? Because they had no oversight by a president or Congress. So basically gave them free rein to create their own laws, their own rules, their own fines for violating the laws, which they collected, and they get to keep. So if you give one agency that kind of power with no oversight, they're going to create tons and tons of laws and rules and regulations and fines because they make more money that causes them to be able to grow. And that can go unchecked and that can get crazy. Now, the CFPB, the Consumer Financial Protection Bureau, they cover all kinds of financing and such. Everything from credit card loans, car loans to real estate. Now, in the real estate sector, which is probably the largest money part of it there, HUD already did this. The Department of Housing and Urban Development. They actually already had a guide to shop for loans. They didn't call it the Your Home Loan Toolkit. That's something fancy that the CFPB created, a new name. All right. Now, HUD had a lot of the documents that are required to be given to consumers. At the beginning of the loan, when you first apply for a loan, lenders are supposed to give you what's called a GFE, the good faith estimate of what your estimated loan costs are going to be at the beginning of the transaction. The CFPB is trying to justify their existence, so they renamed a lot of the existing forms. They may have changed them around and reformatted them a little bit too. So they came out with a new name for the GFE, the good faith estimate, and they just call it the LE, the loan estimate. And then before closing, 3 days before closing, the lender needs to provide to the consumer the actual loan costs. They used to do that on a document called the HUD-1, the RESPA HUD-1 settlement statement, which accounts for every penny in the real estate transaction and where it goes. The CFPB changed that closing document, and they actually made it a lot more difficult to create. The purpose of it was supposed to be to streamline things, provide more information to the consumer, and make it easier so that loans can close quicker. But it had a little bit of a backfire a little bit there, causing them a little bit longer because it's harder to fill them out. But either way, this document that the CFPB now has for the closing is called the CD, the closing disclosure. So we need to know what the old forms were called by HUD and what the new documents that the CFPB created to replace them with. And we need to know the timelines that they need to be given to the consumer. Don't yell at me. Don't take it out on me. I didn't create this stuff. All right. Now, one additional thing to that, I said that this Your Home Loan Toolkit to shop for and compare loans must be given 3 days after the completed loan application. Aliens. So what does that mean? That means that the loan application is considered complete when the lender provides all the information from this acronym, aliens, when they provided the address of the property being purchased, the loan amount requested, the income of all the borrowers, the estimated value of the property, the names of all the borrowers, and their social security numbers. Only then have the aliens landed, and the lender is required to give these disclosures to the consumer. So that disclosure would be the toolkit on how to shop for loans and the loan estimate. Now, they're required to put it in the mail within 3 days of the completed loan application. However, nobody's required to explain it to the consumer. I guess they're focusing on creating regulations and fines. Whatever. Real estate licensees should go over this information that's in the toolkit with the consumer. I always did. I always told them, hey, listen, don't let a lender tell you not to go shopping for loans and comparison shopping by going to other lenders, because they'll always tell you, oh, that's going to mess up your credit score. And it's going to have an impact on your credit score, and you may not qualify for the loan anymore. I tell consumers that you should shop and compare lenders. Just don't go to 50 of them, because that could have a negative impact to the point that it does affect your shopping, your ability to get the loan. But if you go to a couple of lenders and comparison shop, they expect that. It's going to have a minor hit on your credit score of a point or two. If a point or two is going to make or break whether you get the loan or not, you probably shouldn't be shopping for a house yet. You need to get your financial house in order before you start shopping for a home. Okay, that's how I'll explain it to the buyers. Listen, not everybody should be a buyer just yet. You should get your finances in order. Don't be so quick to rush out and buy a home. You got to be financially stable. So here's the resources. I got a couple of resources for you to educate your clients so that you could be better agents. Here's a link to the toolkit that the lender is supposed to provide to the borrower. I also have a guide here from the Real Estate Commission, which is awesome. It's an excellent guide, although it needs to be updated a little bit. I notified them. I don't know if they're doing it or not, though. Maybe I should notify them again. This is an excellent guide they put together, but it does require a little updating. And then there's also a home buyer's guide from the New Jersey Housing Mortgage Finance Agency. It's pretty good, similar to the Rex guide, but the Rex guide is still kind of better, even though it's kind of older. This one is interactive, so it may wow people. So let's take a look at all three of them really quick. So the CFPB's toolkit takes you here. You could download the booklet, and it does have some interactive features like exploring a sample loan estimate. You know, you could ask questions, they'll give you answers. And it even got calculators that you could plug in to get information. Adjustable rate mortgages, et cetera, et cetera, et cetera. Anyway, you also have the home buyer's guide from the Real Estate Commission, which I think is excellent. Let me get to the beginning of this. All right. Everything you want to know about buying a home. And by the way, if you follow along this guide from the Real Estate Commission, it kind of falls in line with wasn't created by the REC. It was created by the Department of Banking and Insurance. Oh, I know the REC is a division of the Department of Banking and Insurance. Okay, so this was created by the DOBI. Maybe I reach out to the wrong person. Maybe I got to reach out to them to update this booklet. Okay, so, but either way, look at it. It goes over some pretty interesting stuff. Getting started to buy a home. Actually going shopping. Choosing a real estate professional. How to make the offer. Getting ready for the settlement. Insuring your home. Sealing the deal. Talks about everything from the final walkthrough to closing to recording the deed and the mortgage. Talks about tax advantages of being a homeowner. Let's see. Here we talk about debt to income ratio, something that we didn't dive deep into yet, but we're about to have it, I think, on the next slide or two. And qualifying ratios. This is the debt to income ratio that lenders use. So what is that? I guess we could read it together here. The debt to income ratio is one of the first factors a lender may consider when deciding how large a mortgage loan you qualify for using your debt to income ratio, also known as a DTI. To calculate the debt to income ratio, you got to add up your current monthly debt, all your credit card payments, car loans, etc., and divide it by your total monthly pre-tax gross income. This percentage ratio is a simple way of showing how much of your income is available to make a mortgage loan payment after all your other debts obligations are met. Lenders often call this the 28-36 qualifying ratio, although that ratio, some lenders may allow higher numbers on them. This is your typical 28-36. The first number, 28%, indicates the maximum amount of your monthly pre-tax gross income that the lender allows for monthly housing expense. The amount will include the principal and interest of the loan, your property taxes, and homeowner's insurance, or PITI. The second number, 36%, refers to the maximum percentage of your monthly pre-tax gross income that the lender allows for all monthly housing expenses plus recurring debt. If your ratio numbers are higher than 28-36, You may want to consider reducing your debt and paying off some credit cards or other loans before starting a home search. When calculating and relying on your DTI to determine loan affordability, be confident with your numbers, and don't be afraid to stick to them so that you don't overextend yourself when getting a loan, and then you'll be struggling to be paying all your bills every month. Okay. Anyway, this goes on and on and on and explains you down payment, private mortgage insurance, which we haven't gone over yet and are about to, interest rates, adjustable rate mortgages, rate locks. Your lender will give you the option to lock in a rate quote for a specific period of time, often 60 days. A rate lock fixes the rate against the rise in any interest rates, right? Let's see, your credit score, how to get a free copy of your credit report, FICO scores, pre-qualifications. It goes over all that stuff. It's actually a pretty good guide to give to buyers to look over when you start working with them. And then you've got the guide from the NJHMFA. Whoops. It looks like they removed it or moved it. Let's just look at, I guess we'll have to go to the HMFA's website, I guess. Let's see if we can look over here. Huh? NJHMFA. All right, I'll have to find that link. Apparently they moved it. Let me see if I can find it again. Let's see, NJHMFA Home Buyer Guide. All right, I got it. They just no longer pay for that for it to be interactive. But I found it on the HMFA's website. Actually, they have the website, what is it? njhousing.gov too. njhousing.gov. Let's see, maybe they still have the interactive one. So here's what I found. Here's what I found, the guide. I'll share that with you guys since it did change the link. Open my Zoom chat. There you go. I'll fix it on the slideshow too. Okay, so this is that guide for shopping for the home. Not sure if this was updated at all. I just found this on their website. Their website, njhousing.gov for the consumer, will take you here. And let's see, they got some information here for different programs that they have. Where's that home toolkit? All right, looks like I found it, but I don't think that they got that here anymore. They also have On Your Way Home or Find Your Way Home or something like that as their thing. Let me see. So here's another link for New Jersey Housing Mortgage Finance Agency. Here we go, a guide for New Jersey home buyers. Nope, it takes you to that same PDF document that I just showed you. It's also available here in Spanish as well. So NJHMFA down payment assistance programs, different mortgage programs, programs for police and fire and teachers and all kinds of stuff like that. You can look up some of the videos and presentations they have and fact sheets about their different programs. Let's keep this another window. And we'll put these all on an updated slide. That's coming up. So let's just keep going through the pushing through. So these are the 3 home buyer guides here, basically. And I could share them with you from the slideshow. I'll just copy them and give them to you here in the chat window. Okay. So the Your Home Loan Toolkit, what does that discuss? What does that go over? Well, how to determine a loan affordability, how do credit scores affect your ability to get a mortgage, a mortgage financing, how to choose best loan and down payment, understanding trade-offs between points and interest rates, the value of shopping several lenders, and how to avoid the pitfalls and problems in the transaction. It discusses the loan estimate, the LE, the loan estimate, and the CD, the closing disclosure. And here are some references on what pages they are in this book, where we go over loan estimates and closing disclosures. Now, the Your Home Loan Toolkit, let's highlight. Lenders are obligated to provide within 3 business days of their completed loan application. Now, conventional loans, government, JHMFA, the Rec D. So conventional loans originated by portfolio lenders. These are lenders who lend their own money. They don't plan on reselling your loans to investors. They keep them in their own investment portfolio. That's why they call them portfolio lenders, or sometimes they refer to them as conventional lenders who write portfolio loans. Sometimes they word it backwards too. But either way, conventional loans or portfolio lenders are lenders that write their own loans without the intention on reselling them to investors. So these loans are directly between the lender and the borrower with no third-party involvement or influence from any outside sources who may set guidelines for the types of loans they're willing to buy. You ever hear that when somebody goes to the bank or to a lender to get a loan? They say, "Oh, you don't meet the guidelines." What guidelines? Who makes up these arbitrary guidelines to borrow money from us to get a loan? Well, your lenders, your local banks, they usually write loans with the intent of reselling them to investors so that they can get the money back that they lent to buy the house. So this way they could write a new loan to someone else to buy a house that they could then sell and get the money back, so that they could write a new loan. Because banks make money off of originating loans in several ways. They they get paid a servicing fee to from those investors they sell the loans to for collecting the monthly mortgage payments still and rendering accounting to them. They also make money anytime they write loans to create new money. They also make money by selling those loans. They get all the money back, plus they get paid some interests. Because if they would have just kept those loans, we've seen you could make a lot of money by holding on to the loans on the interest payments, right? So those investors will pay you back all the money that you paid to originate the loan, plus some of that profit, the interest. That's how your local banks make money. That's how your local lenders make money. So because the lender doesn't plan on reselling those loans, they have more flexibility in who they lend to. In most cases, your local banks plan on reselling the loans. They write the loans with the intent of reselling them so they could get their money back and write another loan. They don't plan on servicing it for the long haul. Conventional lenders or portfolio lenders, they keep those loans for the long haul. So they don't care about any third parties' arbitrary lending guidelines for the criteria of the borrower or the real estate that somebody's going to buy. Because you can say, oh, we can't buy that kind of property in that price range or whatever, because of the borrower's debt to income ratios or whatever, because it doesn't meet our lending criteria for the loan products we're willing to buy. Okay, so then your local bank says, well, sorry, we can't give you the loan. You don't qualify for it. Why don't you qualify for it? Because they're not going to write a loan to somebody that they can't resell to get all the money back right away. That's why. Unless they're a portfolio lender. Portfolio lenders don't care about any third parties' lending guidelines because they don't plan on reselling the loans. Does that make sense? Did I explain that clear enough? Or has anybody got any questions on that? No? Okay. So government-backed loans include those from the FHA. FHA does not lend money. They insure loans. What does that mean? Well, they put together lending guidelines, and then they say, if you go to your local bank to get an FHA loan, FHA's got their lending guidelines for that the borrower must fit in and that the property for purchasing must fit in. Whether it's a 1, 2, 3, or 4 family house, it can't be over a certain dollar amount. They got all kinds of other criteria. So as long as the house that you're buying meets their criteria and the borrower does, the FHA tells the lender, the bank, they say, lend this back your money, and we will insure you against loss. So if they default on the loan in any way, we'll foreclose on them and take the property back and sell it at auction to try to get the funds back. But you don't need to worry about any of that. If they default on the loan, we'll handle that. And we'll pay you back every penny so you don't lose a penny in the transaction. So it's good for the local banks. That's why they're always pushing FHA loans, because it's no skin off their back. They're fully insured by the federal government. That if that borrower defaults, as long as they meet the lending criteria that the FHA set, the local lender will lend the money, because now it's insured by the federal government, so the bank won't lose any money. Pretty good deal for the bank, right? Low risk for the bank, right? That's why they don't care if it's got a really low down payment requirement of 3.5% like the FHA does. All right, and then the VA, that's the Department of Veterans Affairs, they guarantee 25% of loans made to veterans in the event that the veteran defaults. So it's as if that veteran put 25% of the cash down when they buy. This is why these are considered 100% financing. Borrower doesn't need to put any money down because it's the federal government, the Veterans Affairs Department of the VA. They're putting down, or they're guaranteeing 25% if you default. I got a comma there. Or the VA lends their own money. The VA guarantees the loan, the FHA insures the loan. Your local lender is the one that lends the money. Both the FHA and the VA require purchase contracts to include a special amendatory clause. Remember what that special amendatory clause is that we discussed back in chapter 11? It states that if the property does not appraise for the purchase price, the borrower can get out of the contract without penalty. The NJHMFA, that's the New Jersey Housing Mortgage and Finance Agency, they don't lend money directly. The money comes just like the VA or the FHA or the VA. The money comes from the local lending institutions, which then they insure or guarantee. They do both. And loans that come directly from the government, not from a local lender, would be the Rec D. That's the Rural Economic Community Development, formerly called the Farmers Home Loan Administration. These loans are funded directly from the United States Department of Agriculture. They're loans not just to farmers, but also to people who are buying homes in rural areas. Somerset, most of that is a rural area. You live on the other side of New Brunswick, that's Somerset right there. You know that even though it's like right by the city, it's right by New Brunswick, right by the college. It looks like an urban area right there still. It's actually considered rural. You could get 100% financing for buying a home over there. Yep. So once again, what's an urban, suburban, or rural area? Well, urban is densely populated with a large population of people living close together. Suburban is people living further apart. And rural is a sparsely populated area where people live far away from each other. So let's make our highlights here for now. Conventional loans, government-backed FHA, VA loans. I got some notes written in here that the maximum seller concessions allowed for FHA and VA loans is 6%. The loan amount. Loans directly from the government are from the NJHMFA and the Rec D. And then I got an arrow here from conventional loans down here talking about portfolio loans, and that the maximum seller concession allowed for a conventional loan is 3% of the loan amount. I'll give you guys a moment to take the notes on that. I'm going to be right back. Okay, I'm going to go get me a drink. Everybody got their notes there?
Yes.
Okey-doke. So, how does lending work in a nutshell? Well, most lenders, they don't lend their own money. And those that do, we call them portfolio lenders. They write conventional or portfolio loans, depending on who you're talking to, what they call them. So, who do consumers generally get loans from? Well, they get them from banks. They get them from credit unions, which are basically nonprofit banks, and investors. So, what kind of investors write loans? Well, who supplies funds? These private investors that write these commercial loans. Well, who has a lot of money to do that? Insurance companies, right? How much do you pay in insurance, and how often do you get paid out money from the insurance companies? So they're sitting on a boatload of money, and they're not stupid. They're not going to just sit on a pile of money. What they do is they reinvest it. Can you make a lot of money lending? We noticed that in interest, you sure can. So they reinvest that money. They don't just sit on it to make more money. So banks lend their depositors money. Now, technically, this is an incorrect statement. Technically. But it gives us a better visual to have an understanding. So we'll go with that for now. And then I'm going to show you a couple minutes of that video from Money as Debt that will explain to you how lending works actually. So banks lend their depositors money. That's what most people think, but it really is not how it works. But banks lend their depositors money according to some third-party investors' criteria, which we call lending guidelines, for the loans that they're willing to purchase. They then sell that loan later to get their depositors' money back, plus some of the interest paid up front as a profit. Sometimes these investors will also pay the bank a servicing fee to continue collecting the monthly mortgage payment and do the billing and render accounting to the consumer and the lender. Now, the primary mortgage market or primary market is where loans are originated to the consumer to buy real estate. That's known as the primary market or the primary mortgage market. That's where loans are originated to the consumer to buy real estate. The secondary market is where those loans are then that were originated in the primary market are resold by those lenders to investors, which are often other banks or insurance companies, private investors, etc., who would then buy them. So primary market, that's where loans are originated to the consumer to buy real estate. Secondary market, that's where those loans are resold to investors, which are usually other banks. They usually package them up and sell hundreds or thousands of these loans. They call them mortgage-backed securities. Do you know that if banks write a lot of bad loans that default, that people fail to pay, they can lose their banking license? You guys know that? But banks write bad loans all the time. How do they not go out of business? Simple. They get those loans off their books. If they're not on their books, you can't say that it's theirs. How do they do that? Well, they package the bad loans with a bunch of good ones and they sell them off to some investor. Now it's not on their books anymore. Why would an investor buy bad loans? Because they make it worth their while. They package up a bunch of good with the non-performing bad loans so that it's in their, that the juice is still worth the squeeze for them to purchase it, right? All right. Now, I'm going to explain to you why this is technically a wrong statement by saying that the banks lend their depositors money. It's a visual, it gives a good visual, and a lot of people can understand it easier. And that's the thought that most people already have. It's like, how do the banks pay you your interest by when you deposit money in their accounts? Where do they get the money from to pay you that interest? Where does that come from? You know, well, they invest your money and they charge interest on it. They get it back and they share a portion with you, right? It's easy to understand it that way, but banking is more simple than that. And it is so simple, it will blow your mind. Where do the banks get the money to lend, to write loans? Do they lend their depositors money? Is that really a fact? Is that really what they do? No, they actually just conjure it up out of thin air. They type it in a computer. Look, this is I showed you a portion of that video, that cartoonish-like video from that the money as debt, to when we were talking about usury, charging an illegally high rate of interest. That same video will show you and explain this to you. I'm going to play you about 10 to 15 minutes of this. Let me see how much time we got left. We got a half hour. But by the way, I'll still play you about 10 to 15 minutes of this 45, 47-minute video. And I think it's great. It'll explain to you how lending works in a nutshell. Now, there's a second version of this video. It's called Money is Debt, Promises Unleashed, Part 2. To appease to the other economists that argued with the guy that created this video, because he said, technically, one thing you said is incorrect because you oversimplified it just a little bit smidgen too much. So he corrected it with creating a new video. And in doing that, I think he kind of screwed up some of the messaging. I like the first video better. So we're going to play it right now. Let me see. Look at this. Permit me to issue and control the money of a nation, and I care not who makes its laws. Mayor Anselm Rothschild. You ever hear of the Rothschild family? Uber rich bankers. These are the Rothschilds. These are the ones that come from that video, The Men Who Made America, the what do you call it? American Dynasties, and there was another one, the Titans of Industry. There's a video series, the Rothschilds. They were part of that too.
Two great mysteries dominate our lives, love and money. What is love is a question that has been endlessly explored in stories, songs, books, movies, and television. But the same cannot be said about the question, what is money? It's not surprising that monetary theory hasn't inspired any blockbuster movies, but it was not even mentioned at the schools most of us attended. For most of us, the question, where does money come from, brings to mind a picture of the mint printing bills and stamping coins. Money, most of us believe, is created by the government. It's true, but only to a point. Those metal and paper symbols of value we usually think of as money are indeed produced by an agency of the federal government called the Mint. But the vast majority of money is not created by the Mint. It is created in huge amounts every day by private corporations known as banks. Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off, and the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our Goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, how would anyone find out? This new scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers.
You guys ever go to the bank and try to withdraw a large amount of money from your bank accounts ever? And they told you that you had to set up an appointment because they may not have the money for that to give it to you? Did anybody ever go to the bank and experience that? You know, this is what today, many banks don't even have vaults anymore. So they don't hold large amounts of money there, just enough to start the day's cash drawer, to do the transactions when people come in. And when there's a run on a bank, if a bunch of people come in there to try to demand their money out of the bank, that's a run on the bank. And if the banks don't have this money, it could put them out of business. So what do? They actually partner with each other. Every bank that does banking in the United States is a member of a central bank. We call that the Federal Reserve. The Federal Reserve has nothing to do with the federal government whatsoever. It is a central bank here in the United States that every bank is a member of. So if there's ever a run on a bank, the Federal Reserve will step in and provide the money that's needed to cover it so that they don't go out of business. They're all in cahoots with each other, basically.
It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion. So instead, the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down. Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk to nothing. The basic nature of money has changed. In the past, a paper dollar was actually a receipt that could be redeemed for a fixed weight of gold or silver.
You guys remember that? Where you see bills they actually say on the bottom, it would say redeemable for the face value in silver or gold. They no longer do that because so much money was created, more than the available silver in existence. So they did away with this altogether.
In the present, a paper or digital dollar can only be redeemed for another paper or digital dollar. In the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse, just as we have the choice to refuse someone's private check today. In the present, privately created bank credit is legally convertible to government-issued fiat currency, the dollars, loonies, and pounds we habitually think of as money. Fiat currency is money created by government fiat or decree, and legal tender laws declare that citizens must accept this fiat money as payment for debt, or else the courts will not enforce the obligation. So now the question is, if governments and banks can both just create money, then how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantities of whatever commodity was in use as money. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug out of the ground. In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consists of three things: the amount of government-issued cash that the bank has in its vault, the amount of credit it has with the central bank, and the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. Investors have paid for the bank's infrastructure and have supplied it with sufficient cash to meet the demand for cash withdrawals. Typically, cash in the vault will amount to no more than $1 for every $20 or $30 that could be demanded from the bank. The bank has joined the central bank system, which permits the new bank to borrow cash from the central bank if it's needed. The doors open, and the new bank welcomes its first loan customer. The customer needs $10,000 to buy a car. On approval, the bank creates an account for the borrower and types in that the bank owes the borrower $10,000. This $10,000 is not taken from anywhere. It's created on the spot. The borrower does not take this money out in cash. Instead, he writes a check on his account to buy the car. The seller then deposits this newly created $10,000 check at her bank. At a ratio of 9-to-1, this new $10,000 deposit allows the seller's bank to create a new loan of $9,000. And if that $9,000 is then deposited by a third party, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls, each layer of which contains a smaller doll inside, each new deposit contains the potential for a slightly smaller loan in a decreasing series. Now, at any stage, if the money created is taken out in cash and not deposited at a bank, the process stops. That's the unpredictable part of the money creation mechanism. But more likely, at every step, the new bank credit money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new bank credit money has been created within the banking system. All of this new money has been created entirely from debt, and all transactions have been carried out with bank credit. None of the banks involved have needed to use any of the cash in their vaults. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be said that any one bank got to multiply the initial $10,000 of bank credit into $100,000 of bank credit. However, the banking system is a closed loop. Bank credit created at one bank becomes a deposit in another, and so on and so on. In a theoretical world of perfectly equal exchanges, the banks would owe each other nothing at the end of the day, and the $10,000 created out of thin air as a loan by the first bank could indeed become almost $100,000 of new loan money in the banking system. If that sounds ridiculous, try this. Actual reserve ratios can be much higher than 9-to-1. For some types of accounts, 20-to-1 and 33-to-1 ratios are common. There are also many exceptions where no reserve requirements apply at all. So, while the rule...
All right, so if you guys like that, you found that interesting, I'll share this video link with you in the chat window. You guys can watch the rest of this movie on your own. I think it's extremely interesting explaining how lending works in the world and how the money is created out of debt. And if you guys ever paid attention to or watched any of these videos or documentaries from some of these billionaires and millionaires that teach you how to make money, you have everybody from Donald Trump to Robert Kiyosaki to oh my God, what the hell is his name? Any of these millionaires, they teach you, like, look at Robert Kiyosaki. He's got this whole series teaching you. He's always talking about debt is money. He's like, I don't get rich from owning anything. I don't want to own anything. I want to use my money to buy stuff. I want to use other people's money. I want to buy stuff. You get real wealth is developed from debt. You don't use your own assets, your own money. You use other people's. Because then when you do it that way, you could write it off. There's interest on loans, and those loans can be written off, and then you don't need to pay taxes on it, because the way it's looked at as debt. It's not looked at as you having an actual asset. So it's pretty interesting, though. From most millionaires and billionaires you talk to, they don't use their own money. They use other people's stuff, even though they got money. Money as debt is the name of this. And if you continue watching through this, it'll explain it pretty good to you as well. So I shared with you, did I share with you in the chat window there? You guys got that? Money as debt? Yep. The last link, I sent it to you. All right. So let's go back to the slideshow and continue the class here. I just wanted to share with you that video about how lending and borrowing works, because I told you, you lend your deposit, banks lend their depositors money. We learn now that's not really what happens. They just create it out of thin air. They conjure it up. It's pretty messed up. Wish we could do that, right? But no, that's how it works. All right, so conventional loans are loans that are directly between the lender and the borrower with no third-party involvement or influence. So a lender that lends their own money that's not reliant on any third party's lending criteria that would determine whether they grant you a loan or not. they're called conventional loans or portfolio loans. Okay. You get them from conventional or portfolio lenders. So if you ever have a client who's having trouble getting a loan because they didn't meet the lender's lending criteria for whatever reason, try taking them over to the portfolio lender, because they have more flexibility. They could make real world decisions based on real life. For example, I have a friend who bought a house through me one time. He's an investor, and he used me as, you know, his agent. He was buying a 2-family house, and it was only $200,000 for this 2-family house. The rents from the 2 units would have paid for the mortgage itself. He owns 15 homes, 15 rental properties. He owns a bar, cash business. He's a fireman. He makes a decent buck. His credit score was 840. Excellent credit score. The guy couldn't get a loan for a $200,000 house that would pay for itself. So I took him to a portfolio lender, and they examined his situation. They looked at his tax papers and everything, and they were like, okay, we see what's going on here. Yeah, the guy's an investor. We see this. This is common. So he's a low risk that he's going to default. He just has a lot of write-offs. So with some banks, it's the debt to income ratio seems like it's off because he writes off. He has a lot of write-offs on his taxes. So it looks like he's spending all the money that he's making. So a lot of lenders won't lend to him because the debt to income ratio is beyond the limits that they allow. He also owns a lot of homes. There's a lot of banks that have lending criteria that say, for example, if you own more than 5 homes, then you don't qualify for this loan program. You know, there's all kinds of lending criteria like that for the reason why he couldn't get a loan through traditional means, you know. So I took him to the portfolio lender, and I asked them, I was like, well, will you give them a loan? And they're like, oh, yeah, not a problem. Yeah, we lend our own money. We don't care about any third party's lending criteria. So we'll lend him our money because we see that he's not a big risk. The guy was never late on a mortgage payment. His credit score is phenomenal. 840, that's phenomenal credit score. The guy's got a cash business, the bar. He's probably not reporting half the money he's making, you know, and he's just got a lot of write-offs. And I was like, yeah, I got to attest to that. I've seen this guy. He is cheap. Go ahead. Ask me, Vic. How cheap is he? All right. I assume you're saying, how cheap is he? Okay. He's so cheap that when he goes to Home Depot and he sees a receipt on the ground, he picks it up so he can write it off on his taxes. All right. That's why, see, there's one problem there, though, that I just uncovered for you guys. You guys are going to be working as real estate agents. You're going to be independent contractors. You should keep track of your expenses so that you could write them off on your taxes against your income. But I warn you, be careful about having too many write-offs, because if you ever try to get a loan like my friend did and you have too many write-offs, it appears like you're spending all the money that you're making, so you're going to have trouble getting a loan. So keep your legitimate write-offs there so that you could take advantage of not paying taxes on your actual expenses. But don't get too crazy with it if you start doing stuff like he is with picking up receipts off the ground and writing them up off of on your taxes, okay? All right, so that's what a portfolio lender is. You don't take people who have trouble getting loans because they don't pay back their loans. You know, they got a poor credit score. They don't pay their credit cards on time, things of that nature. portfolio lenders are not going to write them loans because they're risky people to lend to. But if you have somebody who's not high risk, but is having trouble getting loans elsewhere, you can take them to a portfolio lender and they will get a loan. See, if you know these little insider tricks here, these little details of how lending works, you could use it to your advantage and set your clients up with the knowledge that you've gained. Take your clients to a portfolio or conventional lender, right?
How they how can you find them? Are they listed as portfolio lenders in Google?
How could you find a portfolio lender is a good question. Let me see if I got it on the next slide that's coming up before I answer it. Well, it's not on the next slide, but it's in a couple that are coming up. So let me finish this slide and I'll skip to that one to show you really quick, okay? So let me see. Don't confuse conventional loans with conforming loans. A conforming loan is one that must meet some third parties' lending guidelines. They meet the guidelines or they conform to their guidelines, okay? Conventional loans do not mix with conforming. They're the opposite. Conventional loans does not care about third-party lending guidelines. Conforming loans have to meet third-party lending guidelines. And Fannie Mae, you may have heard of them, they're the world's largest purchaser of loans in the secondary market, those conforming loans. So whenever they change the lending criteria for the types of loans that they will buy in the secondary market, what do you think your local lender does with the lending criteria to originate loans to consumers? They change them to match. Because they know if Fannie Mae is the largest investor out there that buys, they own one out of every 10 loans in existence. So if they're going to buy, if they're most likely be the ones that buy those loans, we should change our lending criteria to match theirs, right? That's the way lending works. That's how they come up with these arbitrary lending guidelines. So the lender has the final say in who they lend to in a conventional loan because they're lending their own money. So therefore, they're more flexible. But that doesn't mean they make risky loans. The maximum seller concession allowed for a conventional loan is 3% of the loan amount. And they typically require larger down payments of 20% down or more, although I have seen them as low as 3%. Now, what determines that? I don't know, the relationship with the borrower, maybe, the risk involved. I don't know. It should be around 20%, but I have seen it as low as 3%. But if it is anything that requires less than a 20% down payment, private mortgage insurance is required. So if the LTV is higher than 80%, meaning the borrower's putting down less than 20, the lender will require the borrower to pay for private mortgage insurance, which insures the amount less than 20% we put down. Okay, so these next slides are all about that. Oh, actually, we're done right here. The next slide is about the portfolio lenders that you were asking about. So how do you find a portfolio lender? There you go. You drive around. You ever see large construction sites, maybe building several homes or maybe high-rise buildings and things of that nature? Those things are not common construction projects. So there's not like a set lending criteria for that type of a construction project. But they'll usually have signs like on the construction fences around the project saying that this project is funded by whatever the lender is. Well, you know what? They're a portfolio lender because they're lending their own money. There's no lending criteria for that project right there. So, boom, that's how easy. Usually, if you ask the mortgage rep, a mortgage solicitor, is your lender a portfolio lender? Do they lend their own money? They're always going to say yes, but they're not always portfolio lenders because often these mortgage reps don't know what the hell they're talking about. because they're always pushing FHA loans anyway.
And its portfolio lenders known to give lower rates or higher, if it's equal credit.
No, they give good rates. They give good rates. It's not that they give higher rates because you couldn't qualify somewhere else, so they're going to rake you over to Kohl's. They'll give you good rates. So here's some local portfolio lenders that I know of to help you start you out a little bit. Amboy Savings Bank, PPAC Gladstone, Provident, Unity, Columbia. I used to have RSI, Railway Savings Institute. They've been open for 150 years, I think, but I think about a year or two ago, they were bought by Columbia now. And Santander, although Santander, they usually only lend their money for like really large projects, not like they probably wouldn't lend to you for a small little project that you're going to do, but for these huge projects. All right, so what is PMI? What is private mortgage insurance? I guess we could discuss this tomorrow because it is 4:33. My, how time flies. But wasn't this kind of an interesting conversation, the video and talking about how banking actually works and how the lending criteria are formed? It's kind of interesting because this isn't stuff that's usually spoken about out there in the world. All right, let me throw out there for you. Well, first of all, let me stop the recording for the day. We'll continue this chapter 14 tomorrow here where we left off.